can start recording. All right, thank you. Good morning, everybody. Let's go ahead and get the Police and Fire Department Retirement Plan and Healthcare Trust meeting started. Today is December 3rd, 2020. Let's go ahead and do a quick roll call. Myself, Andrew Gardner is present. Drew Lanza.
Here.
Sunita Ganapati.
Present.
Howard Lee. Eswar Menon.
Present.
Nick Muyo.
Here.
Richard Santos.
Yes.
Vince Sinceri.
Here.
Franco Ovato.
Here.
All right, so we got all the trustees except we're still waiting for Howard Lee. Pam Foley is usually a little bit, our council member usually comes after a closed session. Our general and fiduciary council is present. We got our CEO Roberto Pena and CIO Prabhu Palani, and a lot of our staff is here too. So let's go ahead and jump into closed session. And we'll come back, we'll reconvene around 9:30 to look at the, start the rest of the agenda. have any orders of the day to announce. We'll just go ahead and continue practicing. Continue practicing the current way we handle these meetings on Zoom. There is no sunshine to wave at the time. And so we'll go ahead and move to one, consent calendar. Is there anything on the consent calendar that people wanted to pull for discussion? If not, I will take a motion to approve the consent calendar.
Santos to approve.
Motion by Santos.
Howard, second.
Howard, second by Howard. Any other public discussion, comments? If not, do a roll call vote. Lanza.
Aye.
Ganapati.
Aye.
Lee.
Yes.
Menon.
Yes.
Muyo.
Aye.
Santos.
Yes.
Sinzeri. Votto.
Aye. Aye.
All right, I heard the aye from Cesare and Votto, and myself, Gardner, aye. All right, consent calendar passes. So let's go ahead and move to 2.0 investments, oral update from CIO Retirement Services, Prabhu Palani.
Thank you, Mr. Chairman. Good morning, everyone. I have some performance numbers to report. These are, of course, preliminary numbers. Today in the main session, we'll actually have Casey Boyer and Laura Wyrick reporting on third quarter performance. But before that, we do have October and November numbers. I may have shared October at the last board meeting that was a negative 74 basis points. November was up 6.27%, obviously very, very strong market there. And on December 1st, we were up 53 basis points. So calendar year to date up 10.39%, which of course the calendar numbers are less relevant for us. Fiscal year to date up 12.66%. And quarter to date through December 1st was up 6.04%. And the healthcare trust had numbers, similar numbers in the same ballpark. But of course, Laura will do a more detailed performance update through third quarter in a few minutes, and Casey will do it through June 30th for private assets. Also, trustees, it gives me very great pleasure to announce two promotions, and I've been waiting for this for a year. These individuals on the investment team were first promoted a year ago, but then COVID happened and it got pushed back. But it gives me great pleasure to announce that with immediate effect, Jay Kwan has been promoted to Senior Investment Officer, and David Ong has been promoted to Investment Officer. And you both know Jay and David quite well now. They're tremendous investment. They've added a lot of value to our investment program. Jay has, for the newer trustee, Jay has an undergraduate degree in economics from Stanford, an MBA from Oxford in the UK, several years of work experience on the buy side for one of the leading investment managers before he joined ORS maybe about six plus years ago. And David has an undergraduate degree from UCLA, a master's degree in financial mathematics from Claremont Graduate School, was a principal at KKR, the private equity firm in the risk group for 6 years prior to joining San Jose. So clearly very distinguished backgrounds, lots of experience. They can work anywhere, but they've chosen San Jose as their employer and public service, and for that I'm grateful. So please join me in congratulating those two individuals. Well-deserved promotion there.
Hear, hear.
And with that, Mr. Chairman, I'm happy to take any questions before turning this over to Casey Boyer.
All right, thanks. Trustees, any trustees have questions? If not, before we pass it on, Jay, David, congratulations. This is well-deserved and it's been coming for a long time. Thank you for your patience. Prabhu has been, been trying to work on this for almost a year now, but, due to COVID and things, really slowed down. That thank you for your patience. Wish it happened earlier, but glad it did. So thank you. Prabhu, I'll go ahead and you go ahead and turn it over to the next item.
Thank you, Mr. Chairman. Do we have Casey online?
I am online. Can you see
Dave?
me?
Yep.
Hear me? Great. I see the presentation on the screen there, so I will go ahead and get started. First off, again, thank you for having me. Definitely appreciate the opportunity to update you all each quarter and stay in contact on where we are within building the portfolio and the development of returns. So as probably mentioned, I'm going to be reporting on Q2 performance. And I'll give just a little bit of background on, obviously it's been a very crazy year, and there's been a lot that has happened, a lot of unknown, and continues to be unknown on what we'll see going forward. But I have a little bit of Q3 information that I can share as well, so I thought I would do that. As you know, Q1 returns valuations were down. I think overall we saw about a 9% decrease in your portfolio in Q1, which we of course expected and was in line with public markets. Went down further than that, but definitely affected some of our valuations as well. A lot of GPs were also being very conservative in Q1. A lot of their companies were still performing through March, but they did take a proactive approach of writing down investments. Now for Q2, we've actually seen a quick return of investments. So if you look on page 2, you'll see the legacy information broken out. The middle column there is the Neuberger portfolio, and then on the far right, you'll see the combined. The returns have, as I mentioned, have come up, and they are actually for Q2 back to what essentially was lost in Q1. So great news. It was a little bit of a volatile year, but we are back into the realm of where we were before COVID. And the way it's looking for Q3, we haven't actually reported Q3 just yet, but it looks like the portfolio will be up again for Q3, somewhere in the 8 to 9% range. So again, positive developments. The private equity market continues to be very strong. Lots of funds continuing fundraising. The fundraising process is going very quickly. In terms of co-investments, which is where we invest directly into companies, a lot of companies still are requiring, and are being valued at high valuations. Of course, the only ones getting those high valuations are the companies that are very good assets. So we're seeing a lot in the market. There's a lot coming to market. We've had a lot of opportunity, so we look forward to continuing that for your portfolio. So overall, these are kind of the statistics of the Neuberger program. We've committed a little over 230 million on your behalf, and the returns are 1.1 net multiple, so a little held over cost, with a 12% net IRR. That compares to Q1, which was an I think 1.5% IRR. So we are up a little bit. Moving to page 3. The following pages 3, 4, and 5, and 6, I won't hit on all of them specifically. The first 2, 3, and 4 benchmark the legacy portfolio. So the funds that were invested in prior to starting the Neuberger program, and how those benchmark against their peers. So on the right, you'll see the quartiling metrics, first, second, or third, based on the IRR or the multiple of invested capital. A lot of these quartiling metrics and performance for the legacy portfolio, especially on page 3, will not move a lot anymore because they have been, they are quite old funds. And so a lot of the performance at this point is already baked. If you turn to page 5, this page starts the Neuberger portfolio and the quartiling for the investments within that program. You'll see the vintage year for each one of the funds, which means that is when the fund started their investing. There's still quite a few funds that are very early in investing. So you'll see, some funds being held under cost. A lot of times that's simply because they've only made one investment and are still working themselves out of the J curve. So at this point, no funds that we are worried about. It's just simply early in the process. I'll turn to page 7. Page 7 is a fairly new slide. We actually added this in Q1. So this is the second time you'll see that you've been seeing this slide. Just to give a little breakdown of the exposures within the portfolio. So along the top, you see how the portfolio is broken out in terms of investment type. So whether it's a primary fund investment where we're making an investment directly into the fund at the beginning, a co-investment into a company, or a secondary, which is where we are buying assets in the secondary private equity market. You'll see it in a couple different ways based on committed capital and invested. So committed is kind of overall where we expect the capital and what has been committed to date. And then invested capital, which is the dollars that have actually been put in the ground to date. So the great thing about co-investments and secondaries are they are very efficient with capital. They put capital into the ground immediately for your program. So you'll see on the invested capital, co-investments at a much higher percent, about 41%, secondaries 7%, and then primaries, those investments are still deploying capital, and you'll see that percentage rise over time. Overall, we have a target for your portfolio of about 70% into primaries and the remaining into an opportunistic bucket of co-investments and secondaries. On the bottom, you'll see how that relates to geography. We typically do have a very high weighting towards North America due to the maturity of the market, and just the opportunities within the private equity market. So a 70 to 80% North America allocation is very consistent with how we invest our capital. You'll see how that is working within the Neuberger portfolio. And then on the far right, for each type, you'll see how that works into your overall portfolio, including the legacy investments. So in terms of geography, the more we invest, you'll see that Europe and rest of world getting slightly larger within your overall portfolio. Page 8. This is an analysis of the overall performance and how that benchmarks your portfolio. So at the very top, you see the performance of each investment type, primary, secondary, and co-investments. Again, all of them are up since Q1. As I mentioned, secondaries and co-investments are an efficient use of capital. They put capital into the ground quickly, and they also start generating returns quicker than primary. So it's always a great addition to the portfolio. And we've seen that here as well. And at the bottom chart, on the bottom chart, you'll see how the Neuberger portfolio, Neuberger and San Jose portfolio is benchmarking compared to its peers. So at this point, the returns here are as of Q2. The benchmark is as of Q1, so it's a little bit apples to oranges. And that's simply due to the fact that it takes a while for the benchmark reports to become available. But so far, portfolio is performing right where we would expect it to perform in terms of where it is with its peers. Obviously still very early, and we expect a lot more in terms of performance. I will mention here though that when you see the first quartile, that is actually based on what your Q1 returns were. So your Q1 return was 1.08, which does make it a first quartile return. And pages 9 and 10 are just a very detailed overview of every investment within the portfolio, including both legacy and Neuberger investments. I won't go through all the detail here, but on page 10, you can see how that relates just in terms of overall totals within the portfolio. At this point, Neuberger and those investments are almost 40% of the portfolio, and the legacy is about 60%. Yeah, I think with that, I'll open it up for any questions.
All right, thank you, Casey. Trustees, Eswar.
Thank you, Andrew, and thank you, Casey, for the presentation. So, I mean, one thing which, people talk about this recovery is a K-shaped recovery. Some companies doing well and some not. And as you see opportunities and as, we deploy capital, how are you skewing between, like buyouts versus growth equity?
Yeah. So I think within our portfolio, we're very opportunistic. We do have target allocations within buyout, growth equity, but we're able to really assess where we put capital on an individual basis. So for our primaries, that's a little bit more, you have to anticipate that a little bit more and actually, pick which funds and which asset class you want to be in for the long term. One great thing about having an opportunistic bucket for co-investments and secondaries is that you really can focus on a specific company, and whether it's growth or whether it's buyout, figure out what the positives are of that company and really incorporate it into your portfolio. So for instance, over this time period, Asia, while the US was kind of going through more of the COVID pandemic, I would say in March, April, May, obviously it continues on, Asia had actually started to recover from their January, February outbreak. So we actually had a lot of investments in deal flow from Asia during that time period. there was quite a bit of kind of the growth buyout, which in reality, it can be a very close, a thin line between the two. And so overall, we've seen a lot from both asset classes globally. It's been dependent on kind of where countries are in their COVID process. But to answer your specific question about which one we maybe lean towards, I would say it's very dependent on companies. And I think our co-investments specifically, we are really able to figure out which companies have performed well through COVID, which ones have strong capital structures, strong free cash flow. And those are the most important things we're looking at, whether it's growth or buyout. A lot of those tend to be, if they're going to have a ton of free cash flow, more buyout. So it's really, instead of looking asset class specific, it's really looking at the fundamentals of the business and figuring it out from that aspect, and not holding ourselves to a very strict, set allocation.
Okay, thank you, Casey. And one more question, investment 45. That's 2017 and still showing, a big down mark, right, in terms of valuation. Anything going on there?
So the only thing I would say that's going on there, that company still only has made one investment. So they, if anything, I would say, are just being very slow to deploy. The kind of information you're seeing there, I think the portfolio, the one company they have is held at just slightly under cost, about I think it's 0.95. So there's nothing wrong with the company. I think it's been doing okay through COVID, but the fact is, since they only have one company, since it's not written up, and it was invested in quite a while ago, it's really seeing the J curve. So we're obviously hoping that they can get some capital deployed here pretty quickly and start making some investments that can hopefully generate some more return.
Okay, thank you. That's all, Andrew.
Thank you, Eswar. Any other trustees have questions for Casey?
Find my raise my hand button. This is Sunita, sorry.
Yep, go ahead.
I guess I had a couple of questions for Casey. One is probably basic for some of the other trustees, so I'll qualify that. So the legacy portfolio, is that still active, or is that just sort of a passive portfolio?
I'll start it, and then if Brian wants to add anything, I'll let him do that. So there have been some investments. You'll see on page 5, there were some investments. Sorry, I'm on the wrong page. On page 4, some investments in 2018. So I'm not exactly sure what the investment team has in terms of what they expect to do next, but I think there's possibility.
Yeah, so I would say generally we expect to do virtually all of our buyout type investments through the fund of one that we have with Neuberger Berman. They've really demonstrated the value that they can bring through that partnership. That being said, I think the type of organization we have the benefit of being opportunistic and flexible with our private markets program. So every once in a while, there could be a situation in which, we would want to do something outside of that. So no hard and fast rule, but we would not necessarily anticipate continuing anything in the legacy program.
Is there some coordination that you don't sort of land up doubling down?
yeah, lots of coordination between our team and Brian and his team. Calls with them at least weekly. Most of the time we're speaking more than weekly. So we share with them and go through diligence on every investment that we put in the portfolio. We have forward calendars, model portfolios, so they can see years in advance of what we're looking at. So I don't think, in my opinion, there's really no chance of overlap.
Yeah,
Yeah, go ahead.
well, I just, would echo that. The way this partnership works is Neuberger Berman has their process, and their deal sourcing and their underwriting and a 140-person team that does that. But we are a lot more than just a passive recipient of what they do. We're very actively engaged, and ultimately we do have the ability to say no to an investment, or to indicate, that we like it. We do think it should be part of the portfolio. So it is truly a partnership.
The other question I had was, I know there's a lag between information, particularly in the private equity space. So can you give us some non-numerical color, so to speak, on what's been happening over the last 3 months since this was put together?
Sure. So I would say in general, the private equity market has really rebounded from Q2, Q1, over Q3, just in terms of private equity activity and kind of deals agreed and announced. Q3 was up almost double of what Q2 was. So there's been a very quick return to companies being sold, bought and sold. So Q3, I believe, is almost on par with what was happening in terms of activity for Q1. And I think that's mostly because any company that really did make it through COVID in a positive way, they were quickly brought to market. In Q2, if they had planned on having a sale, they held off. They wanted to get more numbers in. As soon as they were able to get Q2 numbers in and really show the market that their company made it through COVID and actually did well, then they were ready to sell. So overall, markets in terms of activity have really come back, and they've come back very strong. We've definitely seen it in our deal flow. Our deal flow is slightly down overall in terms of 2020 compared to 2019. But when you look at it by quarter and even on a weekly basis, our numbers are right back up to where we were in 2019 and Q1. So lots of activity. I mentioned briefly before fundraising activity. There are lots of funds in the market. We have not seen any slowdown in funds coming to market or the timeline that they expect to close their fund. In fact, it's probably quicker than it ever has been. So funds are able to come to market. We've seen many do a first and final close within months of starting their fundraise process. So I think that just goes to show that private equity firms really have done well through the last 10 years. And even experiencing kind of this volatility of this year, if they have performed well, they're able to come to the market. There's a huge demand still for good funds. So we've seen that as well. We've had to be very on top of our fundraising and forward calendar to make sure we're in front of the funds that we want to be in front of.
I sorry to interrupt, but I think my question perhaps wasn't specific enough. I meant more relating to our retirement exposure here. Has there been more capital deployed or more commitment calls, etc.?
Okay. So our commitment pace, I would say, within your portfolio specifically, has been on pace similar to what it has been. So we always have a model portfolio for your program. Our expectation was that we would make 3 primary fund commitments starting in basically the summer, so 2020 through next year. We've actually made those 3 commitments, primary fund commitments. We are still committing out of the co-investment secondary bucket. So that will continue through next summer. The deal flow, I would say, for the co-investment bucket has been, we've had a lot of deal flow. So we've had to, and Brian could speak to this as well, really look at how much we have remaining to commit and compare that to how much we have in our deal flow pipeline right now. Because if we were to not look at it in terms of how much we have left and remaining to commit, the capital would be gone very quickly. And we're trying to be a little bit careful in making sure we have commitments and capital through the summer of 2021. So
Casey,
yeah.
maybe I can chime in there. I'll be a little more direct about it. The deal flow has been amazing, and I've had to say no to a lot of things that were kind of interesting, because the one thing that we don't want to do is be in a situation where fantastic opportunities arise because of maybe future dislocations in the market and we don't have capital to deploy because we've hit our target. So in the March-April timeframe, when the board changed its asset allocation, we reduced the buyout target from 8% to 6%, which was a significant shift versus the target that we've had for several years. The consequence of that is that we are hitting our target asset allocation number earlier maybe than we would have anticipated. So that does limit the amount of capital that we have for buyout type investments going forward.
I think it might, may I make a suggestion if the other trustees find it useful? Given this is you come every quarter and there's a lag, maybe there could be a page on at least a qualitative bullet points on what has happened in the quarter that's passed in terms of commitments and where we are versus allocation. And if there are more opportunities that way, at least we know, we can start thinking about it, I guess. But that was helpful. Thank you.
Yeah. We'll work with Neuberger to put something like that into the next report.
Thank you, Sunita. Any other trustees? All right, if no other trustees, thank you, Casey, for the excellent presentation and answering all the questions for us. And happy holidays, and we'll see you next quarter.
Thank you. I appreciate it. Bye.
Bye. All right, Prabhu, I'll turn it over to you for the next presentation. This one will be by Makita, presenting the second quarter 2020 private market equity report.
Thank you, Mr. Chairman. Thank you, Casey, for your update. And items 2C, D, and E will all be covered by Laura Wyrick. So I'm going to turn this over to Laura to cover those items with, of course, time for discussion and questions between each one of them. Over to Laura.
Great. Good morning. Hello, everybody. I hope you're all doing well. Can you hear me okay?
Yes.
Great. So my colleague Jared Pratt is going to share his screen. We're having a crazy Santa Ana winds down here in San Diego. So if I'm coughing, it is that's the reason. Nothing more nefarious. So here on the screen, we have the second quarter 2020 private markets report. So As usual, this is the public version. We provide a more detailed version to staff. And it also is lagged by a quarter, as you know, given private markets valuations availability. So if we take a look at page 2, you can see the overall summary of the private markets programs. The Neuberger Berman Fund of One is the second line, which Casey Boyer just discussed. You can see the legacy private equity, and then the private debt, real estate, and real assets, which tend to be natural resources and infrastructure. And you can see on the far right that the internal rate of return for each of these programs for San Jose is compared to a public market equivalent IRR. So you can think of that as a benchmark, as if you had put your funds in public markets instead of private. And that's a complicated calculation that takes into account daily valuation, since all of the underlying funds in private markets call capital over time and also distribute it. So you can see that for each of your private markets programs, your internal rate of return is higher than what you would have captured in the public markets, with the exception of private debt, which is relatively close. But as we've discussed in the past, private debt is still dominated by some investments that were made 10 years ago and were designed to be opportunistic at the time. And those are still rolling off in the program. So we can skip ahead to page 4 to look at commitments this past quarter and the second quarter. So there were 2 new private debt funds committed to with $12 million, Crestline and Eagle Point. And you can see below the largest contributions and distributions for the quarter. You can see that there were more contributions than distributions in the second quarter. Taking a look at page 6, we can see the individual funds that make up the private debt program. You can see that there were 3 funds committed to in 2010, and then several that took place prior to the current staff coming on board. And then if you look on the far right, you can see, I think I would say, improving performance relative to the peer benchmark with recent funds that had been committed to. And then taking a look at page 7, one thing I think is notable here is often we see a lot of dominance, especially in legacy portfolios by certain vintage years, but you can see that your portfolio is really pretty well diversified from a vintage year diversification perspective, which is important because we never know exactly what the market is going to deliver in any particular year. The funds are slightly dominated by Western Europe right now. That's in part due to Cross Ocean, which is a Europe-focused fund in which your fund has invested in a couple of their vintages. Next, I'll move on to the private real assets program, starting on page 8. Right now, the value of this program is only 1% of the total fund relative to a 3% policy target. So it's still a young, developing program. And you can see on page 9 that there was 1 new commitment this quarter, Lime Rock New Energy, with a $9 million commitment. So you can see, given how young this program is, there are more contributions going into it than distributions coming out at this point. I'll take a look next at page 11 of 42, where you can see the individual funds in the program. And you can see, the first fund in this program was only committed to a few years ago, Brookfield Infrastructure. There's been 2 vintages of Global Infrastructure Partners, 2 vintages of Lime Rock, and then Kimmeridge Energy as well. So you can see that there's only a couple of funds that have a meaningful IRR yet that have been around for a few years. Brookfield with a very strong IRR relative to the peer benchmark, and Global Infrastructure Partners a bit weaker, but we do expect that to change as that fund matures. Taking a look at page 12, you can see that the majority of the exposure was in 2016, but a lot of that is just flowing out of the fact that it's a new program. Private real estate starts on page 13. You can see that we're right near a policy target for real estate at 3.4% of the total fund relative to a target of 3. And there are 16 investments in the program. On page 14, you can see that there were no new commitments during the second quarter, but you can see the contributions and distributions over time. I'll skip ahead to look at individual funds on page 16. So it's a pretty well-diversified program in terms of vintage year. You can see that the IRR of the program is in the double digits at 10%, and that's pretty much right on with the peer IRR for the total program. And then taking a look at page 17, as I mentioned, you can see that vintage year exposure is relatively diversified with a bit of a weight in 2015 and 2017. You know, historically, I think we'd concentrated the exposure, but it's now becoming more diversified. And then at the back of this presentation, we have some slides on the current market environment. But I know that Neuberger discussed that somewhat, and I can take any questions in the interest of time.
Thank you, Laura. Any questions, trustees, on the private market presentation? Vince.
Thanks, Andrew. My question is really around sizing of some of the commitments. I noticed on, looks like page 6 and 7 for private debt and real assets, particularly if you look at originally there in 2020, we've had 3 commitments of $12,000 each. I'm sorry, $12 million each versus previous commitments, which were much larger in size. I'm just wondering why we're getting so spread out and why we're not making larger commitments, maybe to fewer names.
Sure. I will answer and then also defer to Brian Starr as well on staff. So as you know, there are pacing plans that are approved and then staff and the consultants carry them out. I would say on private debt in particular, you are overweight the target with the new asset allocation that was adopted in March. So right now there's 5.1% in the private market or private debt program relative to a 3 target. And so I think when we do see attractive opportunities, you know, in order to commit and diversify, those bite sizes are coming down. Particularly the few investments that were made back in 2010 were originally a 5% of the fund opportunistic target rather than part of private debt. But you're right that there have been some very high commitments relative to what's happening now. On private real assets, you know, the same thing really where we're trying to diversify between infrastructure and natural resources and not take too much risk, particularly when you get into energy. That can be a really volatile area. And so not putting too many eggs in one basket, I think makes sense. But I'll also defer to Brian Starr, who has a major influence over how investments are sized.
Yeah, I think Laura hit on the main point, which is like in 2014-15, when we were doing private debt, the fund had an 11% target allocation and was significantly underweight. So the pacing plan and subsequent sizing was trying to get to 11%. And then in short order, it went from 11 to 8 to 5 to 3. So, you know, when we look at sizing our funds today, I think relative to the amount of capital that we intended to commit per year, the sizing actually hasn't changed. We're still trying to do, you know, 3 to 5 funds per year and get a diversified portfolio across a variety of strategies. In real assets, it's a similar concept. I would suggest that there may be greater dispersion of returns in private real assets than there may be in private credit. And as a result, we're skewing a little bit smaller there and would probably do maybe 1 or 2 more funds, both because of the diversity of strategies that exist within private real assets and the dispersion of returns that would result.
Okay, thank you.
Thanks, Vince. Any other trustees?
Looks like Sunita.
On the real estate portfolios, given, you know, we've continued to see a big run up in valuations despite COVID, are you expecting more distributions? Are people trying to exit, or are they continuing to reinvest in some of these funds? Is that a trend?
Yeah, you know, I think it is an area that the how it shakes out remains to be seen. So I haven't seen major shifts in strategy from your underlying funds in terms of trying to liquidate a lot of the portfolios or trying to make a lot of new investments. I think a lot of folks are sort of just staying the course at this point, and waiting to see what happens. There could be some really long-term secular shifts in terms of more people working from home and that sort of thing. But for the most part, I think most businesses, office, those types of things are still making payments to their landlords, and a lot of people are just sort of holding tight for now. But again, if Brian has other things to mention.
And this is Dinesh from the investment staff. So I think Laura's right. The thing that we've noticed is there's a big slowdown in transaction activity. So a lot of managers are trying to be more patient, waiting for the markets to open up, and taking longer to hold on to assets beyond what they had originally planned for, but spending more money to maintain their assets. So more of a wait and see approach. And it also varies by property type. So the property types that are seeing more activity right now are industrial warehouses and multifamily apartments, and other asset types such as office buildings and hotels are more negatively impacted, including retail as well.
Thank you, Dinesh. Any other trustees? If not, Laura, we could go ahead and move on to the presentation for Q3 performance report for the pension fund.
Great. Okay, so I'm really excited to present this report today because of how fabulous your returns look, and that's always great to talk about. So starting out with the market environment on page 4, you can see that the third quarter was a really strong quarter for risk assets. Emerging markets equity was the strongest performing major asset class with a return of almost double digits for the quarter. Followed by US equities with the Russell 3000, commodities, which bounced back a huge amount, up over 9%. And then followed by small cap stocks, developed international, and then high quality bonds at the bottom. But really every major asset class posted a positive return for the third quarter of 2020. And that's despite some volatility within the quarter and negative returns for individual months, but came back very strong. If we take a look at page 5, the one thing that I'd highlight with the longer term returns, which is going to be the story of individual manager performance throughout the report, is the huge gulf between large cap value dominated really by IT, or I'm sorry, large cap growth dominated really by IT and healthcare, and small cap value. So if we look at the 1 year, the Russell 1000 growth, which is large cap growth, was up 37.5%. Small cap value, the Russell 2000 value was down 15%. So just, a gulf of more than 50% between a large cap growth stock and a small cap value stock. And you'll see that in the manager returns as well. So with that, I will skip ahead to your individual performance starting on page 22. As usual, we have in here some commentary. We have changes at the individual managers. We have the watch list, which has not changed. I'm happy to take any questions on any of that, but I will start on page 22 with the total asset allocation for the pension plan. You can see that the current allocations for individual asset classes were very close to their long-term targets. These are the targets that were adopted in mid-March with probably the most fabulous timing of any institutional investor. And you can see the total market value of 4.1 billion as of the end of September. Taking a look at page 23 for performance, you can see that the total fund for the quarter, and which is also the fiscal year to date period, was up 6.1% in that 3-month period, bringing the calendar year to date to 4% and the trailing 1 year to 9%. You can see that the return for the quarter and the year to date period, which was a period that was marked by a huge decline and also a huge rebound. So lots of different individual tiny market environments within that calendar year to date period. Both of those time periods, your plan was in the top decile of peer returns of the public defined benefit greater than $1 billion universe. We also have, as you know, a variety of benchmarks, the policy benchmark, the investable benchmark portfolio, which is what you could implement without private markets and through indexes, the low cost passive portfolio, a 60-40, and also the liability benchmark portfolio. And you can see that recent returns outperform all of those benchmarks and the peer group. The reason for the outperformance, if you look through individual asset classes, is that nearly every asset class outperformed its relevant benchmark. Particularly bright spots were in public equity. Global equity was up just for the quarter, 11.3% for your fund. Emerging markets equity was also up double digits, up 11% for the quarter. I'll take a look and highlight a few individual managers starting on page 27. As I mentioned, an enormous gulf between growth and value. So if you take a look actually at page 28, you can see Artisan Global Opportunities was up 14.1%, nearly doubling the global equity median for the quarter, and top decile returns over every trailing time period since you hired them in March 2013. So it's been a story of really a great time for the asset class, global growth, but also really a strong outperformance by your manager in that space. It's a really concentrated portfolio. Even Cove Street Small Cap Value on this page, which I think you might recall has struggled a bit historically, being in that value space and being highly concentrated, did much better than the Russell 2000 value and the value equity median. So that's nice to see, even though value was more challenged. And then taking a look at page 29, Oberweis International Opportunities, which is a non-US small cap growth manager, was up 18.3% just for the quarter, 32% for the year-to-date period, that 9-month period, and 43% for the trailing year. Top decile returns again versus the peer group for all trailing time periods since you hired them in March of 2014. And then within emerging markets equity, GQG is really a strong story. If you recall, GQG is run by Rajiv Jain, who left a prior firm, Von Tobel, that you had in your portfolio. We all waited for him to get situated and start his own firm. And then he also provided a fee discount to your plan and other investors who followed him to his new firm. And he's really executed incredibly well since you hired him in July of 2017. Also largely top decile returns, more than doubling the emerging markets index for the trailing year with a return of 23%. And the story here is just really strong stock selection in mainly growth names and also strong country selection with some big outperformance in China and Taiwan. So those are the managers that I wanted to highlight. And then I wanted to skip down to page 51. Just to talk about overall portfolio risk statistics relative to the peer group. So if you take a look at page 51, you can see that the return for the trailing 1 year was ranked very highly. The standard deviation, which is a measure of risk, was lower than the peer group. So you had a higher return, a lower risk. And so the measure of risk adjusted return on this slide, which is the third column, the Sharpe ratio, you can see your circle there at the very top of the peer group, ranking in the 5th percentile. And then another, just to dig into the peer relative performance again on page 56, we know that you all get beat up when peer performance doesn't look good, and so we want to highlight it when it does. And so if you take a look at page 56 here, you can see the really strong performance versus the policy, versus the investable benchmark, and also versus the peer group for these trailing time periods more recently. So I'm happy to take any questions on the pension retirement plan performance. It looks like there's a few raised hands. Should I?
I apologize. I was on mute.
No problem.
Vince.
First of all, I just want to congratulate the investment team on the strong performance. If we move to page 49 of this presentation, I think Prabhu has been our CIO for close to 3 years. I don't know the exact date. but we're in a situation now where.
I'm sorry, it cut out.
Can you hear me now?
Yeah, I think it's my internet connection, but can you please repeat the page number that you were looking to see?
Sure, page 49. Hey, we're there. Okay. So we have, in the past at the investment committee, talked about trying to get our plan moved into the northwest quadrant. And you can see that we're finally starting to shift into that area where we're slightly outperforming our benchmark. We're doing it with less risk. We're there on a 1 and 3 year basis. This represents the time period that Prabhu has been our CIO. So I just want to make note of that it's really good to see that we're moving in the right direction. I do have a specific question on Artisan. I know that we are using 2 different investment teams at Artisan with different styles, but collectively we have nearly $600 million with that firm. It's nearly 15% of plan assets. And I don't know where we sit with our investment policy statement, if we're bumping up against any limitations there. They've been an incredible manager for us, so I'm not eager for us to move away from them, but I am concerned about risk management.
Yeah, I can start, and then I don't know if Christina wants to add anything, but you know, we do view them as 2 different. They are 2 completely different teams. One based in Milwaukee and one in San Francisco. Different individuals. So while they are under the Artisan umbrella, you know, we feel comfortable that you know, there's not the same key man risk. There's not the same execution risk. And things like that. You know, we are constantly evaluating how to allocate public equity, and maybe if Christina's on the line, if she wants to say anything about that, feel free.
Yeah, thank you. I agree with Laura. Artisan, it's a very special situation. Their investment teams are sort of independent of each other, and the way that we blend them have worked out for the portfolio. And we are aware of the sizable allocation we have with each of them. So as of last month, we actually reduced the global opportunities a little bit, given one, they have done such a good job in the past 1, 3, 5 years, and 2, it's a outsized allocation relative to the value strategy. But we definitely would monitor this situation in terms of the organization stability as well as a style balance to make sure that we don't take outsized risk for each of those styles.
Am I right that 15% is where our limit is with any one investment firm?
I don't recall the limit with one investment firm. I think we definitely have a 10% with the one active strategy. We'll go to the IPS and check.
Okay. Again, I understand there are different managers with different strategies. I'm just more concerned about the one institution and making sure that we're in compliance with our investment policy statement. That's all.
Sure.
Thank you.
Thanks,
So
Vin.
just to address that quickly, it is 15%, but it's broken out by different types of underlying accounts, whether it's an SMA or a commingled fund, which in this case, the global opportunities and global value are 2 different types of accounts. One is an SMA and one is a commingled product. So it's you know, kind of a fuzzy situation with regards to the IPS limits, but again, as Christine is noting, something we monitor in terms of firm risk and exposure.
Thanks, Jay, for that. Vince, did you have follow up on that question, or are you good?
I'm all good. Thanks, Andrew.
Eswar.
Yeah, thank you, Andrew. I would agree with Vince that maybe that's an issue, the Artisan issue, something we should, you know, visit, I guess, maybe the IC. A quick question. So the performance is good, and congratulations to the team, investment team, Prabhu and the team. GQG, I think when Christina made the presentation, performance is great, and I asked a question whether the fair comparison would be with the emerging markets growth benchmark. Any thoughts on that? And I think she kind of agreed that maybe that would be the right comparison.
We've talked to our team about that, and we think it would make sense to look at that as a secondary benchmark. You know, if we look at GQG from a style perspective, they are growth, but not quite as growthy as the growth benchmark. And so similar to how we might look at you know, an artisan value with looking at, you know, the broad benchmark and also the value one, we could add that as a secondary benchmark.
Okay, thank you. That's all, Andrew.
All right. Thank you, Eswar. Howard.
Hi, thank you, Laura, and congratulations again to the team. These are great results on this year so far. Just two questions. One's a quick one. Laura, on the summary as well as on the results on the total fund, the growth benchmark is listed as 8.8, but I couldn't find exactly what that growth benchmark is. Could you just mention that? Yeah, right there under growth, and that's not the same as a 60/40 MSCI, is it?
Oh, so the growth benchmark is the specific benchmark for the assets that are grouped into growth, which is assets in your fund specifically that are designed to grow. So public equity, private equity. What else do we include in this bucket? So that's sort of the functional asset class. We have the three functional asset classes, which are growth, low beta, and other. So that growth benchmark is a specific San Jose developed benchmark for the functional growth asset class. And if we take a look, we have a benchmark history at the very back of the book on page 63 that Jared has pulled up. So currently, you know, it changes and has changed historically based on the composition of the growth assets. But presently, it's made up of the individual underlying public equity benchmark, private equity benchmark, two emerging market debt benchmarks, and then credit. So if we look below, the public benchmark then is made up of MSCI USA, MSCI World ex-USA, and MSCI Emerging Markets. So the goal is really to have a passive representation of what's actually in the portfolio.
Okay, and it looks like it gets adjusted periodically?
Yes, when there's changes to the asset allocation, we also change the underlying benchmarks.
Okay, great. And maybe Prabhu's, not to jump ahead to the next couple of quarters, but how are we positioned in terms of what our thought process would be if there needs to be another, I don't want to say dramatic change, but if there's a change as a result of the vaccines either being much better than expected or much worse than expected, or how are we monitoring our abilities to look at the policy where we are at 70 and whether or not that has to be, you know, adjusted at the margins?
Yeah, great question, Trustee Lee. Firstly, I would say that we are long-term investors, and there will be periodic shocks to the market and changes. And I don't anticipate a steep drawdown like the one that we saw in March, where the markets were down 35%. And when that happened, we were fortunate in that we had an allocation to low beta that we took advantage of. But what I would say is that we look at our strategic asset allocation on an annual basis. We can certainly look at it more frequently if required. At a minimum, we look at it on an annual basis. So the way the process works, and this might actually work out well in terms of our timing with the vaccine and its rollout, is that we get capital markets assumptions, revised capital market assumptions from Makita in January. We already actually have them from Veris. I just got them this week. And then we actually poll several other buy-side managers, and we look at their capital market assumptions to make sure that Makita's CMAs are reasonable. And then once we take a look at that, and these are, of course, capital market assumptions over 10 and 20 years, and they're not necessarily over 1 and 3 years. It's just much harder to get shorter term assumptions with any great accuracy. And so we take that into account, and then we discuss that at the IC, we run it through the optimizer, and then we see whether we need to change our strategic asset allocation or not. In general, my bias and my preference is that we look at our risk target, which is sigma 12%, and then we adjust our asset allocation to that, and we hold that steady, and we make minor changes. So for a long time now, one reason why our peer relative performance looks so good now compared to history is that we were undershooting that 12% risk target. But in our defense, we did not know what that number was. And so Veris finally did a study and said, your risk tolerance is 12%. And we were able to take advantage of that with this drawdown, and we changed our allocation to roughly 70-30. And so I think that we would hold this study. Of course, this is a board and trustee decision, but barring anything major, we would probably stick very close to that 70-30 target and make adjustments as needed based on what happens in the market.
Okay. Well, thank you. Thank you.
Thank you, Howard. I do have a question. It's probably more directed to staff, but definitely Nikita could chime in also. Go on page 19, looking at third quarter manager summary, looking at Dimensional and Blue Bay. Dimensional, has underperformed, by 120 basis points over 3 years, 80 basis points over 5 years, and has been always ranked in the 87th percentile. Blue Bay, very similar, but a longer history of underperforming. How much leeway are we giving our managers of keeping them, hoping that they're going to turn things around, versus, a 5-year track record of, of underperforming in the 87th percentile compared to peers, so forth. Can I just get your guys' thinking on that when you view these two, or just in general, these managers?
A great question, Andrew. And to answer the question on Blue Bay, I'm going to look to our new Senior Investment Officer, Jay Kwan.
Yeah, great, thanks. So if you remember, Blue Bay is in the EMD, our emerging markets debt allocation, paired with another strategy, Iguazu. And so the reason for Blue Bay's inclusion in the plan is as part of that structure, Blue Bay serves as the long-only benchmark-like vehicle in that EMD structure. Iguazu, on the other hand, is a long-short, more of a hedge fund type vehicle. And so the two of those paired together puts out a very strong risk-adjusted return stream. And you can see the kind of the results of that in the performance report. It's been a very high-performing part of the plan, actually. Now, clearly, Blue Bay's had some issues holding up its end of that structure. And so we have been for a period of time now looking at different replacements. We actually made a selection, and we're in the process of funding that. So you asked this question right before we changed the manager out. Good timing. But I would expect that actual transition to the new strategy to happen before the end of the calendar year. In general, the decision to change an active strategy can come for reasons other than, say, PM turnover or issues at the firm broadly. Changing a strategy out just because of performance is kind of a complicated decision, right? You're looking at more, how did the strategy perform relative to expectations? So if it's a value strategy, it was included as part of maybe a value growth pairing. So and I won't speak entirely for Christina here, but when I think about dimensional, I think about dimensional as a kind of a pairing with GQG. So GQG was a great strategy we highlighted earlier, but part of the reason we can afford to have that kind of growthier type exposure is that it's offset by some of the value type exposure in something like dimensional. Or in Blue Bay, we have the long-only benchmark-like vehicle paired with Iguazu, which is a little more short-ended in terms of exposure. And so, one of these strategies allows us to hold the other in some kind of paired structure. And so that, we have different expectations for each end of that structure, and then the evaluation is, well, how are they performing relative to those expectations? If dimensional is underperforming because EM value overall is underperforming, that's one kind of decision. If dimensional is underperforming but EM value is doing well, then that's kind of an easier decision. For Blue Bay specifically, well, they've been performing relatively in line with benchmark. Certainly, we've looked for and selected a different option there because it's just been a little bit stagnant.
And Jay, that's good insight in the sense that, you mentioned you're looking at Blue Bay more as a pairs trade or investment and not as a solo investment. And so when we're looking at this third quarter manager summary and just their returns over the last 3-5 years and longer, it's not a good comparison because you got to look at the other side of the trade too. If that's what I'm hearing, correct?
Yeah, that's right. And I don't mean pairs in terms of like we're long one and short the other, but pairs more like if you look at the EMD line for the structure overall, we're performing I would call it lights out relative to the policy benchmark.
Okay.
Part of the reason for that is the inclusion of Iguazu, right? But if we held only Iguazu, then we would have a very high tracking error relative to the policy benchmark. It's worked in the favor of the strategy, but it would potentially lead to high deviations in performance relative to the policy benchmark, which is not something we're really looking for. So we even it out by holding something more benchmark-like in Blue Bay, right? And even though that Blue Bay's kind of had middling returns, that pairing again performing very well with reasonable tracking error. And now we've gotten to the point where we can switch out one of the components of that pairing. The overall weighting between the two maybe will rebalance slightly, but the structure overall is likely to remain consistent.
Yeah, I mean, I think even put more simply, if everything's doing well at the same time, that means we have a risk of everything doing poorly at the same time too, if there's a style shift. And so we're trying to balance things so that there's some insurance that if market dynamics change, a huge amount, that hopefully the allocations, don't underperform a huge amount.
Yeah. All right. Thanks. Any other questions from trustees before we move on to the healthcare trust? If not, okay, let's go ahead, Laura. Let's go ahead to the healthcare trust performance.
Great. My colleague Jared Pratt is both going to drive the screen and talk about healthcare performance.
Thank you, Laura. Hello, everybody. I'll cover healthcare here really quickly. So you can see that the healthcare trust had 194 million here at the end of the quarter. That's up 16 million from the prior quarter end. That $16 million difference is 7 million from cash flows and 9 million from investments. But everything here very close to the policy target. Moving on to performance. There we go. Okay. So you can see for the quarter, matching the benchmark up 5%. That's just for the quarter. Under the fiscal year to date column here, and then for the past year, outperforming the benchmark by quite a bit, up 7.3% against 6.4%. And I've had an estimate through a couple days ago, so through December 1st, just this quarter, so basically 2 months and a day, the plan is up another 6.9%, bringing the fiscal year to date estimate to up over 12%. So very strong returns, November in particular. Very strong market for equities. I know a lot of the investments in here are passive. So one thing I'll just point out before handing it back is we've added a couple slides in here just to add some context on previous conversations So we just added a peer universe comparison in here for a dollar range for healthcare and health and welfare plans between $50 and $250 million in assets. So you can see I'd highlight here for the quarter and for the past year that the plan has done quite well for the past year in the top third of the peer group. And another thing we've talked about in the past is the asset allocation relative to other health plans. You can see more aggressive in equity and more conservative on the fixed income.
Oh, looks like Jared froze.
Relative to a lot of peers. And I know that's something that we're going to, I froze.
Yeah, you're back.
Can you hear me now? All right. Sorry, I keep getting a notification of unstable connection, so I apologize.
Yeah, that's another effect of these winds we're having down here.
So I was just pointing out that we added a couple of pages back here for the universe comparison, and we talked about the asset allocation of healthcare and it being more aggressive toward equities relative to peers, and something to keep in mind when we do the next asset allocation for the healthcare trust. I guess that wraps it up for me, unless Laura, you want to add anything?
Yeah, the only things that I would add is I neglected to mention recent performance estimates since September 30 on the retirement plan and also on healthcare. I think Prabhu mentioned this as well before, but just to reiterate, our estimates through the day before yesterday are that the fiscal year to date performance, so since June 30th for the pension, is up 12.6%, and for the healthcare is up 12.4%. So really strong, really, less than half a year return on both plans.
All right. Any trustees have questions? Vince?
Sorry to keep asking questions here, but I guess I'm thinking this is obviously a much smaller plan compared to the overall pension plan. When we made our strategic asset allocation shift in March, we did not do anything with this plan. How might we go about in the future tying these two together more closely?
Yeah, that's a great question. That's something that we've talked about with staff because often, as you know, when there's a big shift in the retirement plan, we go through the asset allocation process. It takes some time at the IC. It goes to the board. Maybe there's some changes after that. It takes, a couple of meetings at the board. And by the time that shift is usually undertaken and the reporting's updated, it's within 6 months of when we're going to do it all again, with the new asset allocation. And so we've chatted with staff about how we streamline that and bring that either at the same time or, one idea that I think we need to talk about further, but might make sense is to allow staff to move these allocations to implement in the same spirit as the pension, maybe to automate and make things a bit more efficient. So it's a great question and something that we're focused on making sure happens whenever asset allocation shifts in the future.
Yeah, and if I may add, that's exactly right. Laura and I have had several discussions on this, and this is something that I'd like to bring forth to the board in future, is that when we make shifts to the pension plan, that we also in that same meeting follow up with changes to the healthcare trust so that they move in line. And that's something that we will discuss and bring to the board early next year.
Perfect. Thank you.
Thanks, Vince and Prabhu. Any other trustees? If not, Prabhu, do you have any follow-up comments before we close out the investment section?
Yes, I do, Mr. Chairman. Thank you. Firstly, thank you for your kind comments on performance, starting with Trustee Sunzeri and other trustees. Really, the credit for this goes to all of you for how quickly the boards have acted and worked closely with staff and consultants. And Trustee Lanza has actually pointed this out to Roberto and me, and so I'll be remiss in my duties if I also did not, for the record, thank former IC Chair Trustee Oswald, who, when we were going through this process, was the IC Chair and really pushed us to looking at more aggressive mixes in line with our ability to take a 12% standard deviation of risk. And so thanks to all of you that we have done this. and hopefully we'll continue to work together closely. And I'm looking forward to our next exercise on strategic asset allocation. Thank you.
Thank you, Prabhu. And thank you, Laura and Jared, for being here today and going through the 3 different presentations with us. Hope you have a great holiday season and see you next year.
Thank you. Yeah, for anybody that we don't see later this month, happy holidays and thank you very much. Stay safe and healthy.
All right.
Thank you.
Bye.
Bye.
All right, so that takes care of investments. So go ahead and go to 3A, presentations of preliminary 2020 pensions actuarial evaluation results and discussion and action on amortization payment increase rate and economic assumptions. This is a carryover conversation, part 2 from last month's presentation by Bill Hallmark and Chiron. As you remember, at the end of the presentation, we gave direction for Bill to update the information with some criteria that we were looking at, and he is here to present that today. Bill, good morning.
Good morning, everyone. Good to see you. And yes, we have the updated information and some cost estimates and some alternatives for you to look at. So I also have Ann Harper with me, who's going to help me with the presentation. But just to sort of set this in context, last month we presented some preliminary valuation results and reviewed the economic assumptions. We had also done some background on how we got to where we are today. Today we are hoping to get formal adoption on the economic assumptions and potentially some adjustments to amortization methods that we'll talk about later in the presentation. And then January, we would come back with the final pension valuation results, as well as the assumptions for the OPEB valuation. And then in February, we'll have the final OPEB valuation. So just as a reminder, based on the preliminary results, we had found that the preliminary results were very close to the projections we had from 2019. And in particular, the expected city contribution for next year was about 216 million. I think it's 216.4 million. And I will note here, because we'll talk about this later, that for 2023, we're projecting a drop in the contribution before it continues with a gradual increase after that. And that has to do with the amortizations that we have currently set up, and a couple of the amortizations are being finished off in 2022. So the alternatives we talked about at the last meeting were reducing the price inflation assumption from 2.5 to 2.25. Wage inflation, we suggested reflecting the currently negotiated increases. So fire has some increases negotiated for the next couple of years. The police contract is out. So there are no future negotiated increases on that. And then reducing the ultimate assumption from currently 3.25% a year to either 3 or 2.75. We had proposed 3, but in the discussion, there was discussion about potentially reducing it to 2.75 as well. The amortization payment increases. So each year, the dollar amount of the payment on the amortizations increases by 2.5%. We tied that to inflation, and we're suggesting keeping that tied to our inflation assumption. So if we reduce the inflation assumption to 2.25, it would reduce the rate of increase in those amortization payments. And then the discount rate, from the discussion last meeting, we talked about three alternatives: 6.75, the current assumption, or reducing it an 1/8 or 1/4%. There was some concern, given the current budget situations, about hitting the city with larger contributions this year. And so we were tasked with looking at some alternatives and how to address that. And so there are some amortization adjustments we're going to talk about that could partially mitigate the immediate cost impact to the city of any change in the discount rate. So with that, I'll let Ann run you through just quickly the information behind these economic assumptions that we discussed at the last meeting.
Good morning, everyone, and it's nice to see you all. This slide here is showing the distribution of inflation assumptions. On the left side, you're seeing the economic forecasters and investment consultants distribution, and their median is about 2%. And you can see that San Jose Police and Fire's assumption of 2.5% is slightly above that median amount. And on the right-hand side are the public sector pension plan assumptions. You see nationally that San Jose's right in the middle at 2.5% in the median. And then with California, you're on the lower end. And the reason being that California assumptions are slightly higher, it tends to be because California's plans inflation assumption impacts the COLA assumption. And the COLA assumption is really tied to local CPI. So by lowering inflation, you might undervalue pension plans, but this doesn't pertain to San Jose because they have a fixed 3% and 2% COLA. So overall, the price inflation assumption has very little direct impact on your plan. The wage inflation assumption, we are suggesting that you reduce your wage inflation assumption from 3.25% down to either 3% or 2.75%. And what this represents is an across-the-board wage increases and also the payroll growth rate. And as Bill had mentioned, the fire, we already know what those wage inflations will be in the next 2 or 3 years because of the bargained agreements. And so we're proposing to use those in our valuation assumption and then just reducing the ultimate rate down to 3% or 2.75%. The amortization payment increase rate, as Bill had mentioned, that it currently is tied to price inflation, which means that payments will grow at our price inflation assumption, which is less than our assumed payroll growth. And this is a more conservative approach than using a level percentage of payroll. And since we expect the UAL payments to decrease as a percentage of payroll. So we're recommending that we keep this tied to the inflation assumption for a slightly more conservative approach. Now, as you know, there's been this trend in the last 5 or 6 years or so, actually maybe longer than that, for declining discount rates. And those are rooted in the fact that there are declining interest rates. This graph shows the declining interest rates over the last 25 years. The green bars represent that risk-free rate or the 10-year treasury rate. And you can see back in 1995, 25 years ago, the return on those treasuries was about 6.25%, while the police and fire assumed rate of return was 8%. So that leaves a risk premium of just slightly less than 2%. But when you fast forward all the way to 2020 to today, the discount rate has been reduced by only 1.25%, while the the return on the 10-year treasuries has gone all the way down to less than 1%. So what that means is that your implied risk premium has increased by about 5.5%. And you basically have to get your returns from assets that are much more risky than the 10-year treasury. So the basis for setting the discount rate is your expected return on assets. And that is a direct function of how your assets are invested or your asset allocation and what those asset classes are expected to return. Makita provides us with a 10-year horizon on the capital market assumptions and a 20-year horizon. And the median return for your portfolio on a 10-year basis is around 6%. And then when you look out 20 years, it's closer to 6.9%. So okay. So that was
Sorry.
That's okay, Bill, go ahead. You can forward it to the next slide. So the last slide was a static look based on the 2020 capital market assumptions. And we wanted to show you here how those capital market assumptions have fluctuated over the last few years, and especially since 2018. The gray bars represent at the bottom the 10-year expected return from Makita, and then the 20-year on the top. So back in 2016, that range was 6.7% to 7.7%. And then the diamonds represent San Jose Police and Fire's discount rate at the time. So you can see that for the most part, you are setting your discount rate right in that range between the 10-year and the 20-year and have consistently done so, except for 2019. And we know that that was an outlier year where the capital market assumptions were set based on the December 2018 economic environment, where there was a very large downturn in the markets at that time. So the projected forecast for returns was much higher because of because of the base that they were projected on. So we are suggesting the three options of remaining at 6.75%, reducing the discount rate 12.5 basis points to 6.625, or reducing it 0.25% down to 6.5%. Certainly all of these assumptions are reasonable, and they are within these gray block ranges, or sometimes even slightly more conservative than the projected assumed rate of return by Makita. So finally, here we're showing the cost impacts of all of our suggested changes or recommendations for your economic assumptions. There are 5 different scenarios if you want to break it up, depending on how you want, or based on what you ultimately decide. The left-hand corner in the upper block there shows 6.75% if you stayed at that discount rate, but reduced your wage inflation to 3%. It's showing the actual value of assets, the member rate, the city rate, and the city contribution amount. So with this scenario, your funded ratio would be 74.8%, and that's on an actuarial value basis. Your tier 1 member contribution rate would be 11%, and then your tier 2 would be 14%, with the 87% of pay contribution rate by the city, which is equivalent to $215.6 million. Now, if you decided to reduce the discount rate by 12.5 basis points, you see a reduction in the funded ratio down to 73.6%. You see some increases in your tier 1 and tier 2 contribution rates. The tier 2 slightly more of an increase because they share more of the cost. The contribution rate would increase by about 3% of pay, and then the city contribution dollar amount would increase by about $7.5 million. So the same relationship holds if you go down to 6.5%. It's basically double the impact of going to 6.625%. However, if you decrease the wage inflation that actually decreases costs. So you'll see lower contributions and slightly higher funded ratios if you're going to decrease that wage inflation. And that's because you're decreasing the amount of salaries that are projected, which have a direct tie to the benefits. So you're seeing slightly lower benefit accruals. And with that, we'll turn it over to Bill.
Yeah, so before we get into a discussion about the alternatives, I wanted to talk a little bit about our philosophy in trying to set the contribution levels and the assumptions, and then look at potential change to the amortization methods. So the assumptions, including the discount rate, set our funding target, the amount of assets that we think we should have in the plan at this point in time. And so from that standpoint, it's very important to use our best estimate of expected returns in order to target the right amount of assets. However, typically we have not made a change more than 25 basis points in a year. And one of the reasons for that is that large changes in the discount rate have an effect. Well, any change in the discount rate also affects member contributions in addition to city contributions. And there's no method to smooth the impact on member contributions. And so a large change in the discount rate can have an immediate significant impact to member contributions. And we have not wanted to make an increase too quick on the member side. Once you've set the assumptions and we have that funding target, then the amortization methods define really a payment plan for the city to get from where we are today to that funding target, to 100% funding. And we want that method to be affordable for the city. If we weren't concerned about it being affordable for the city, we'd ask the city for $1.5 billion right now to completely fill the UAL. So we do have to have some consideration for the affordability. We like to have a stable plan so that for budgeting on the city side, it doesn't bounce around too much. We don't ask for a lot one year and then a lot less the next, and keep that fairly stable. But we definitely need the amount to be sufficient to fund the unfunded liability. So there's some balancing that goes on here. And the way I think about it is we're trying to find this path between underfunding the pension plan and setting the contributions too high at any particular point in time so that we can get to a fully funded plan. And I think Drew had used the metaphor before of chemotherapy, and I thought that was very good, that you want enough medicine to cure the disease, but not too much that you kill the patient. And so we've tried to steer this path, and our bias has been, if you use this road metaphor, to be as far as we think we can in the passing lane to try and get there as quickly as possible without tipping over the edge to be too high of a contribution for the city to afford. Those are judgments. There's not a specific line you could draw. We've explored different things to try and figure out where that line might be, but it ultimately is a judgment for the board. So with that in mind, last year, we took a look at the individual amortizations for the tier 1 unfunded liability. And just for the benefit of the new trustees and a reminder for the current trustees, each of these little blocks represents a payment on an amortization base. So each year we set up an amortization payment for that year's gains and losses, that year's assumption changes, and that year's benefit changes. And these are the remaining payments for each of those bases. And the light yellow ones are gains and losses. The purple ones are assumption changes. And there are a few green ones that are benefit changes. The line represents the payments in an individual year all aggregated together. And so last year we had this red line that went up and down, up, and then dropped significantly, and then bounced back up. And so in trying to stabilize the future outlook for payments, we adjusted some amortizations and changed it to this blue line. The adjustments were in these white boxes with the red numbers. Those are the periods we adjusted. We had talked about potentially changing these 2005 amortizations that had 2 years remaining, but decided we didn't need to last year. And so that is what is causing this year's contribution to go up, followed by going down, is we are paying off those two amortizations. So if we are reducing the discount rate because we think that's more reasonable, but we're concerned about the immediate impact on the city, one simple thing we could do is extend those 2005 amortizations by 1 year. And essentially, you'd be trading the 2022 and 2023 contribution amounts. They would flip. There's an additional interest charge for 2023, so it's a little bit more total, but that could be viewed as something that might help manage the change in the discount rate. If you just did that one, there's no impact after fiscal year 2023. It's just a switch between those 2 years. So with that, actually, I'd like to switch to my interactive model. So hang on here, I'll stop sharing and I'll reshare with the interactive model. Okay, so hopefully you can see the interactive model. And this is with the current assumptions, but with the wage inflation and price inflation and amortization payment growth adopted, but no change to the discount rate. And here you're seeing the projection of the liability, the assets, funded ratio on the actuarial asset value basis, and the contributions as a dollar amount down here. And so, for example, you can look, if we change this to 6.625, it raises these contribution amounts from 216 to 223, as was shown on the slide that Anne showed you. But in 2023, we would have a decline down to 217 million. And so here we can adjust those amortization periods. Actually, before I do that, let me show you. So here's the amortization graph I was just showing. If we change these to 2 years instead of 3 years, you can see we dropped the 2022 contribution down to 217, but increased the 2023 to 223. And you can see that effect here on the amortizations. The initial one remains approximately the same, but the significant change is in the second year. So we can model different alternatives. I also put the 2007 fire benefits here if we wanted to model that. You could potentially add 1 year to that. That gets you the contribution back to 216 exactly. So I think with that, I would open for questions and discussion about which alternatives make the most sense.
Thank you, Bill and Ann, for the presentation. We'll go ahead and open it up the floor to trustees and staff that want to have input. Go ahead and just raise your hand. I'm calling you. Vince, go ahead.
So I have a couple questions in different directions. Starting on the wage side, I'm actually going to refer this question to Franco. You have a contract that's in place for a year for police. I don't know what that wage number is. And if we consider adjusting to 3 or 2.75, can you give us some sense of how that might align with the thinking that the unions are hoping to negotiate for?
Currently, what we did is our contract expired back at the end of June, but we signed a 1-year contract extension with a just a side letter to leave open any potential wage discussions. So we really have no feel for what's going to happen with that, considering the current environment with COVID and everything else.
Okay. And my second question, there may not be someone in this meeting who's capable of answering it, but it's related to what the city may have budgeted for contributions. They often will anticipate that we may change the discount rate, which means what we may have projected could potentially increase. I don't know if Roberto or someone else in this meeting can give us a sense of how important it is to look at changing our amortization around to account for what they've already budgeted.
Vince, this is Roberto. Thank you for your questions. So a couple of things. I believe usually Sharon Parkman join us in the Zoom meeting and trying to see if she is at the meeting or not. But to your point, we keep the city apprised not only of the presentation, but even after the discussions are heard by the board, we keep the city apprised on the questions and possible outcomes by board's action. And in fact, just yesterday, I forward Karen's presentation to the city. So I just been informed that Cheryl is not at the meeting today. I think you are asking the right question. I know that the city, in their estimates every year, they go about it a little different than we do. And I actually believe that the $5 to $7 million increase in contributions is about around the amount that they always sort of are looking the contribution is going to increase. But, you know, I can't really speak for the city. The other question I will ask if I was a trustee is, and again, we're not a city, you know, I don't have the city information, is whether they feel that the 2022 budget is going to be more challenging than the 2023 budget, right? Because that would answer the question that the bill just mentioned on whether you want to sort of shift the impact of those contributions by changing the amortization, right? So I don't know the answer to that, but I do know that they always expect an increase. So I would say if we keep it at an increase below $10 million from a year to the following year, it may be just about around the expectations that the city has in their estimates.
Thank you. My last question is, Bill, if you can take this back to slide 3, your presentation.
Yeah, hold on. Let's see.
Great, thank you. So the lower slide, we worked hard last year at adjusting amortization to take what was a pretty large cliff out and smooth this a bit in terms of the city contributions. But I'm still kind of surprised here that we have this increasing contribution for the next 9 years or so, where it peaks in 2029 and then starts to fall off. But yet the upper slide is showing our assumptions that it's still this sort of gradual increase to being more fully funded. Why is that not more dramatic given the city contributions? And I guess I'm thinking about this from the perspective of, do we continue to try and flatten the line or the curve of this contribution rate? And what would that impact be on how quickly we get to this funded ratio?
So there are several things in there. The increase that you're seeing is reflecting our 2.5% payment increase each year on the amortization, as well as just growth in payroll being applied to normal cost. So we're showing the dollar impact here. I can switch back to the live model and show it as a percent of pay, where it's much more level or declining going forward. The contribution to getting to full funding, we are looking at a $1.5 billion unfunded liability. And so we're chipping away at that with our contributions. And so it takes a while for it to have a dramatic impact. I think, let me see here, I think in the appendix I had.
As you're looking for that, what's surprising to me though, Bill, is that the increase of the funded ratio of the plan is fairly consistent. It's not like it ramps up dramatically and then flattens out as contributions go down. So that's a surprise to me.
Yeah, it's fairly, and part of that is you're looking at it as a funded percentage instead of looking at the UAL dollar amounts. But also we're looking at contributing 60 million towards that unfunded liability in the first year of 1.5 billion. And so it does take a while for it to come down. Let me, not sure if this is any better, but let me go back to the model so we can show different charts. So here I changed to show the top graph as the unfunded liability. And so you can see how the dollar amount of that unfunded liability goes down. And yeah, we're chipping away at it a little at a time, but we're continually increasing the amount of that principal payment as we chip away. And so then it starts to accelerate how quickly we close that gap.
Okay, that actually helps that chart in particular. Thank you, Bill. Those are all the questions I have, Andrew.
Thanks, Vince. Any other trustees have questions?
I want to make some comments. Andrew, is the appropriate time to make some comments?
Sure, go ahead.
So I was kind of hard on Bill and Ann at the last meeting, and there's been some background emails. And I'm going to be kind of hard on Bill and Ann. And it's not because I don't have enormous respect for Bill and Ann, or I don't personally like Bill and Ann. It's quite the opposite. I'm going to be hard on Bill and Ann because I have an enormous amount of respect for them and because they're really valued partners. And we're going to try to take, at least as the chairman of the board, if you'll follow me, I'm going to try to take us on kind of the final phase of this long meandering journey that Vince and I and your board has been on now for almost a decade. And our Sherpas on that journey will necessarily be Bill and Ann, and so I'm kind of whipping them for the climb to the summit of Everest. So Bill and Ann, if you feel like I'm whipping you, it's just because I don't want to die on the way to the top. So 3 points. So it's always kind of good to, and you guys who've been on board know I'm kind of goofy. New trustees, I'm a little goofy. Bear with me while I be a little goofy. It's always good to kind of stand back and ask yourself where you are in space and time, right? What business are we in? We're in a fairly straightforward business. It's easy to describe. It's hard to implement because it's a lot of bodies, a lot of money, a lot of time. But basically, pension systems used to be pay as you go, and the powers that be wisely decided, well, that doesn't quite work. Look, if we're going to owe a lot of money in the future, we ought to be saving money over time to pay that money in the future. Now, every city is different. Every police department is different. Every fire department is different. And every city is different. And so every pension plan is necessarily different. But they basically have the same goals. They have some pool set aside, not pay as you go anymore. That's our assets. And some predictive future of the payments we have to make. What you've just seen Bill give us in great, and we'll explain detail. Got it. That's the first thing. Now, the second thing is you can look at pension plans all across the world, certainly all across the state and across the nation, and they are not all 100% fully funded. Well, all right, that kind of makes sense. We said the business was to invest these assets and predict this uncertain future of liabilities. And of course, the future is unknown, right? So from startup companies, from my business as a VC, we're in the same business, right? We're startup companies. We're trying to get a product that hasn't been developed yet to a market that may not have seen the product before with people that haven't worked together before. And so we have a system, I've described it once before, and I'd like to introduce this to the board as we go on this journey forward to ask why what we thought would happen, what we planned to have happen, what we tried to have happen didn't happen. There are 3 axes to this. The first one is luck or skill. Well, okay, luck is our factory burned down in a tornado. Well, I couldn't see that coming. Skill is the engineer didn't design the product right, and it wasn't unlucky, he just isn't a very good engineer. That's the first axis, right? The second axis is exogenous or endogenous, and all that means is, was it really under our control or not? So the fact that the tornado caused the factory to burn down is exogenous, but the fact that we might have not had our sprinkler system checked and it didn't work, and that's on us, that's endogenous. And the third axis is a little tricky to describe. It's called the generic or specific axis. And what that means is, was it something that happens all the time and therefore could have been predicted? Hey, you wouldn't expect a tornado in Sacramento, but you bloody well would in Kansas City, right? Or is it something very specific that doesn't often happen? It's pretty hard to predict that people are going to fly airplanes into buildings in September of 2001. All right. Third thing, now getting down to brass tacks. So we know 2 things in life. I mean, it comes from raising kids or driving our car or whatever. We know that there's a difference between absolute and relative. And we learned all that in school, right? Right? If I graded everyone on this test absolute, you idiots don't know biology, you're all getting an F. But if I grade this on a relative curve, hey, some of you learned more and did better than others. Some of you are going to get an A. And that applies to everything in life, whether we're dealing with kids or friends or starting companies. And the second thing that's generic from life is you always have the option to raise the bridge or lower the level of the water. And of course, that's the metaphor that Bill has used consistently for assets and liabilities, right? Now stay with me. I'm going to try to tie all this together. What we've done so far on this board over the last decade has been pretty easy because we've been operating in relative land so far. Now, relatively speaking, it was pretty clear that our discount rate was too high. Now, a large part of that was because of the unexpected low rate of inflation, and you heard that earlier in this meeting. And so it was relatively straightforward for this board to say, look, I don't know the absolute position the discount rate should be on. I don't know if absolutely it should be 6.25 or 6.5 or 6.75, but I know relatively it shouldn't be 8. And so it was very easy to dial it down. And as Bill so astutely pointed out, that knob, if you spin that knob from 8 to 6 in one go, everything blows up. And so we decided early on that we would spin it in increments of 0.25%, maybe 1/8%. So relatively, it's been easy to know what direction we go in. The problem is, and this was highlighted for those of you who were at the offsite that Vince hosted a couple of years ago, we're now approaching the point where we're getting into absolute territory. And so for the assets, we decided, look, relatively, we know to go down. Now we need to figure out absolute. And Vince, I think, very astutely said, look, we can figure out what the right risk for San Jose is. And when we figure out the right risk level, we can build a portfolio to match that. And that's absolute. That's the right risk level. Every pound's different. The right risk level for San Jose, got it. All right. So we've now got that number. We can build a portfolio. We can ask what the expected return of that portfolio is. And that should probably be the return we expect on our assets, the discount rate on assets. We built that portfolio. Bill showed us the results. It's the future's unknown, but to a high degree of certainty from multiple sources, we are likely to see a return of 6% or better on that portfolio. So in absolute terms, and this is the decision we'll make today, our discount rate, our expected return, we've decided the same thing, on assets is somewhere in the 6s. High 6s, mid 6s, low 6s, somewhere in the 6s. Now here's the problem, and here's the summiting of Everest that I think this board needs to do. I kept saying the discount rate for assets. I don't think we know what the discount rate for liabilities is supposed to be. And when you Google discount rate for liabilities, you get about 100 brilliant scholarly works. You get 1 million hits. So we have historically said, well, we'll use the same discount rate for assets as for liabilities. Bill's been saying for 3 or 4 years, you don't have to do that, and it might not be right, which is part of the reason, Bill, you're going to end up being the Sherpa because you kind of volunteered for the suicide mission early on when you pointed that out. I think that we should probably set the discount rate based on what we think we're going to return on assets. And in the back of our mind say, you know what? The actual combined discount rate for assets and liabilities is almost certainly lower. All right, I will wrap this long diatribe up with the following notion. So how do we figure out what level we should set a discount rate for liabilities to? Now, if we have a discount rate for assets and discount rate for liabilities, we can sort of mung them together mathematically and come up with a combined discount rate that Bill and Ann can use for doing their calculations. So what discount rate should we do for liabilities? I think there are 3 steps to that process, and this is the Sherpa to the summit of Everest. First, I'm proposing, and the board can say no, we should look at historically what happened with assets and liabilities, specifically with assets. What are the physics of our liabilities? What have they been over the last 25 years? What can we learn from the past? That's pretty easy, right? I'm learning how to drive a car by driving a car. What happened, right? I stepped on the gas, the car went. Then the second thing I think we should do is apply that error finding thing I talked about. Well, if we've under forecast or over forecast liabilities historically, was it luck or skill? Was it under our control or not? Was it generic or specific? And then the third step is, just as we've done for assets, right? We should come up with a way, not relatively, to set the liability discount rate, but absolutely. And at the end of this, at the end of the next year or two, I think if we've done this right, and if you guys are willing to do this, I think we'll be one of the very few pension plans in the country that can say, here is our plan for assets. Here's how we pick that plan. And here's a reasonable forecast, and we justify for how it will return. And more importantly, here's our plan for liabilities. Here's what's happened in the past. And here's a prudent discount rate for our liabilities. Final thought. When you read those 100 scholarly papers, pretty much to a person, they all say the discount rate for liabilities should be lower than the discount rate for assets. And that observation, pretty much universally made, I think is what should take us on this next part of the journey. Sorry, you guys have been very patient to listen to me, but I am your incoming chairman, and I got a little bone to pick with the whole system. Bill, tell me why I'm crazy.
Well, I think we're going to need to dive into a bunch of those pieces. Probably would be good to do an educational session because the discount rate for liabilities really depends on the purpose of your measurement. And so if you are trading the liability in a market, you would want to use something close to a risk-free rate. We're not doing that. We are trying to set a discount rate for funding, which ties us much more to the expected return on assets. But there's a lot of volatility in that expected return on assets from year to year. And the point of our slide about interest rates declining and how that affects the capital market assumptions is that has completely changed expected returns on portfolios, which has caused us and all pension plans to increase the risks in their portfolio and to reduce their expected returns. So I think that's one piece we need to tie into your model that I didn't hear explicitly taken into account. And that volatility in capital market assumptions and just in actual returns is part of the reason we've talked about having a discount rate slightly lower than the expected return on assets. But it's not the same as many of the academic journals are talking about tying it to a risk-free portfolio or something tied to a corporate bond portfolio. And that's a whole different issue and discussion and purpose.
All right, you got me all hot and giggly, Bill. I'm ready to do this. Are you ready to join us on this 1 or 2 year journey?
Yeah, we're looking forward to some stimulating discussions.
Yeah, I love your idea too, Bill. Let's start with some educations, discussion, start at a high level and start to dig down to what are the real fundamental questions. So I'm a smart enough guy, Bill, to know what I don't know, and I really don't know much. And I'm guessing you know a lot. So I'm looking forward to sucking your brains out through a straw over time. Sorry for the gross metaphor. That's all I've got, Andrew. Thanks.
All right. Thanks, Drew. Thanks, Bill. There's a couple things I want to do real quick. Is I do want to reach out, get Prabhu's comments. Drew made a few comments about tying discount rate to asset returns. I was curious to get some feedback from Prabhu on that. Also want to reach out to Council Member Foley to see if she has any comments that she wants to make in regards to the discussion from a city perspective. And then after that, I hope if Roberto wants to make any comments or anybody else, then I would like to jump in to really dive into and start making decisions and looking at, okay, basically our discount rate, do we want to drop it an eighth to a quarter of a percent? 2 is, do we feel that the city's finances are going to be more stretched this current coming up fiscal year or the following fiscal year, and do we want to help out in that area? Prabhu, do you have any comments that that you want to make?
Sure. Thank you. Thanks, Andrew. So it's hard to follow Drew and sound halfway intelligent, but I will try. Look, there's two things, right? There's discounting liabilities and there's discounting assets. And I'm going to not talk about discounting liabilities. It's above my pay grade, and you all are far smarter and more experienced in doing that. Discounting assets, I happen to know a thing or two about that, so I'll make my comments. I'm largely agreeing with Drew, just putting some color on what he said, and it's similar to how I think about assets. Firstly, thinking about an expected rate of return for assets is not the right way to go about it, because the right way to think about it, and I think Drew did mention this, is to think about our risk-taking ability. And that's the piece I think was missing for a long time at San Jose. And we engaged Veris, and Veris came and said, and spoke to various stakeholders. In fact, Drew asked the mayor this question: what is your risk-taking ability? Recently at the joint meeting. And academic finance will show that you can never predict returns, but risks are reasonably stable. So if you take past returns, it's hard to come up with future returns. But if you take past risks, you can come up with future risks in a reasonable manner. Risk models happen to be reasonably stable, which is why when we run our optimization process for strategic asset allocation, we really start with risk. So the real question we should ask every time we do this exercise is, what is our risk-taking ability? And I'm just going to introduce the word sigma here. Sigma stands for standard deviation. And Veris did a study and said, look, your sigma is 12%. So we always start with our sigma and say, our sigma is 12%. Now that we know our sigma, how best can we, what's the maximum return that we can achieve given the sigma of 12%? And then we look at our pool of our investment opportunity set. So you have public equity, you have private equity, you have commodities, you have real estate, and so on. And so we take all those assets and we come up with reasonable assumptions about what they will return in future, right? We never know if it's going to be right or not. And history shows that we have a bias in overstating these things. But we take Makeda's numbers, we take Veris's numbers, and then we poll, Goldman Sachs and Morgan Stanley and GMO and so on and so forth, and say, okay, Makeda's numbers look reasonable. So we take that combination, and we've spoken about this in the past. We look at this efficient frontier, the risk-return trade-off. We know our risk number. That's the most important number. We know our sigma, that's 12%. We start from that 12% and say, here's the opportunity set. Here are all the assets that we can invest in. What combination of those will maximize return given that 12%? So we always start with the sigma. That's the only thing that we know. We don't know anything else. And then we look at these expected returns and we say we maximize on that efficient frontier. We pick a portfolio that corresponds to the 12% return, which may yield, as Drew said, somewhere between 6 and 7%. We don't know what that number is. And at various times, that number for a 12% return could be as high as 8 to 10%. At other times, it could be 2 to 4%. We have no control over that. We are at the mercy of the market. And we are clearly in a declining interest rate environment. We are clearly in a declining return expectation environment. And so that's why we've been sort of dropping that. So my 2 cents really is to largely agree with what's been said, but to really say, when we start thinking about an expected rate of return for assets, that's not the right way to start it. We should really look at what is our sigma. We should keep looking and challenging ourselves. What is our risk tolerance? because that's the only thing that we can control. Everything else is just a byproduct of what we can do with that risk tolerance. Those are just my comments, Andrew. Thank you.
Thank you,
For
Prabhu.
Prabhu.
Thank you, Prabhu.
I have a question, Andrew, for Prabhu.
Yeah, go ahead.
So the 12% is a annual standard deviation? Or?
That's right.
And so if, given our current asset allocation, do you think we are well optimized relative to the 12%?
We are at 12%, yes. And that's how we came up with the asset allocation is we first take the 12% number, and then we feed into the optimizer our capital market assumptions and come up with a portfolio that matches that 12% number.
And given the current asset allocation, the expected return would be what?
Well, Makita's numbers suggest that it's somewhere north of 7%.
That's the 10-year, 20-year.
That's right.
Okay.
I think it's the 20-year number. Yeah.
Yeah, that's the 20-year.
Understood. Thank you.
Thank you, Sunita. Eswar and Howard, I see your hands up. I'm going to come to you in a sec. I want to jump to Councilmember Foley. I believe she has to leave shortly, and I want to get her feedback see if she has any comments that she wants to contribute to this discussion. Good morning, Councilman Foley.
Thank you, Chair. I really appreciate the discussion and the thought that's going into some of the changes and modifications you might make over this. One of the questions raised was, what is the city estimating as contributions in 2022 and 2023? I've actually reached out to Jim Shannon, but I haven't heard back yet from him. The budget situation for 2022 is, as you might imagine, we are projecting will not be better and improving. It's going to get worse as we go through COVID and survive and figure out what that's going to do as far as our tax base and our lack of income for our conventions and sales tax and other revenues that we're not generating now. And we don't project that 2023 is really going to be any better. So I caution you as the city council member representative, I caution you to seriously look at not increasing the unfunded liability allocation that the city will have to be making in 2022 and 2023. It already, as you all know, it will affect our general fund, and our general fund will affect our ability to hire police and fire in the areas that that are most critical for the city and other resources that we need to retain. So please, do what you can to toe the line or lower the contribution would be great. Maybe extending the amortization schedule if that's a possibility. As a lender, I look at extending mortgage amortization as a way to balance out monthly payments, and that might be a solution. But I know the trustees are very thoughtful, and I appreciate the discussion around this issue, and I look forward to the outcome. But I would hope that you would look to maintaining or decreasing if that's a possibility. Thank you. And one other thing, if I don't get a chance, Andrew, because I do need to leave, is that we are taking a look at pension obligation bonds as a way of addressing the unfunded liability. Hugely risky, but we are moving forward with the certification process, and we'll have a study session on that in April with the possibility of moving forward. So that is one way we are looking at it, addressing the unfunded liability and the pension, the contributions that we need to make. But I have some concerns there, and if possible, I'd love to hear your thoughts about that. Maybe not today, but maybe at our next meeting if we have time. Thank you.
Thank you, Councilmember Foley, for those comments. Go ahead and move on to Eswar.
Yeah, thank you, Andrew. Yeah, I think Drew's point about using a different discount rate for liabilities versus assets, I think it's interesting. I think if you read the literature, I think it's a mixed bag in terms of what people recommend. And so I think it's something, I think it's a learning process for us to go through. And I think it's good that the council is moving forward in terms of the pension, liability bonds, obligation bonds. To me, I think in the short term, there is risk in it. I mean, you can borrow $1 billion and what you invest in could be down. But I think for an entity which has a long-term perspective, I think the risk is low because it's not unlike any other debt that you take, starting from the most basic when people buy a home. And I think in the long term, I think it should be to the benefit of the city.
Thank you, Eswar. Howard.
Yeah, thank you. Thank you, Drew and Prabhu and everyone for their comments, and Bill and for the presentation. I just have two questions, and maybe because I'm relatively new to this, but I have a sense I know the answer to this question. Given how much of a lever discount rates are, they only get adjusted annually, I assume, right? Just because of the nature of this actuarial valuation. There's no way to make a change today to compensate for that in June or July or anything. Is that correct? It's just the once a year?
Yeah, so we review it each year when we do the valuation, and then that valuation sets the contributions that start a year later than the valuation. And so it's because of that budgeting process, you really can't change things more quickly than once a year, because we lock in the city and member contribution rates for the fiscal year.
Okay. All right. And just following what I think Prabhu and Drew were talking about, I know it's an academic effort in some ways to deal with different rates of liabilities, but Bill, you had mentioned something about a proxy setup where you could use some sort of bond funds to sort of have a indication of what some sort of discount rate for liability would be. Is that some sort of methodology that you can incorporate with a little bit of effort going forward, so that way we have a way of how much the discount rate should be tweaked given what we know?
Well, that gets fairly complex. We have talked about it, and I think the board was tracking a liability benchmark return for a while. I'm not sure where that stands now, but you can approximate it by just using the returns on a long duration bond fund. And what we did was determine sort of approximate durations for the pension liabilities. And you could look at the return on a bond fund that had the same duration to get an idea of the return side. The discount rate's really looking at forward-looking returns. And in that case, you'd look more at the yield on that bond portfolio and how that changes. But those numbers move around much more rapidly than what we want to apply in funding the plan, because that creates a lot of variation in city and member contributions. So we need to stabilize that in some way.
I would add, if I can, Bill, Howard, this is part of that historical exercise, at least in theory. I realize we may not be able to pull this off in practice. It should be possible, maybe it isn't, to go back to, say, the year 1998 and paw through the actuarial stuff and say, here's kind of what we forecast we were going to blow out the door in 2020. And then, if that's possible, in 1998, just say what we forecast for 2020, and then to look at what we actually did in 2020, that would impute a discount rate, right? To have taken the actual number in 2020 and brought it back to a number in 1998 is just a mathematical thing of a discount rate. Now, that doesn't deal with what Bill's talking about, which is the right, proper, and prudent way to do it. But it would, I think, if we can do that, Bill, again, just exploration, highlight where, if any, there are systemic biases in the liabilities. I mean, we know now in history, there was a systemic bias in the assets due to our overvaluing inflation. Now, we base it on historic numbers, and we've never been in a period, I certainly not in my life, and I don't think in the 20th century, where inflation was deliberately kept this low. And so I would say, Howard, there is, God knows the actual answer of what the liabilities year to year and forecast to forecast should have been discounted at. And I think the question is, are we going to be smart enough to get at that and then tease it apart to look at where, again, I said the three axes of error, to look at where the errors came from. Sorry, Bill. Didn't want to jump on your feet there.
All right, thank you. Thanks.
Thanks, Howard, Drew, and Bill. Vince.
Yeah, I'm gonna make a motion here for our board, and that is that we adjust the wage inflation to 3%, that we reduce the discount rate to 6.625, which, by the way, will be in line with the Fed plan as well, and to provide some relief to the city, at least in fiscal 2022, we adopt Bill's recommendation of adjusting the amortization that was in the 2005 year to a 1 year time frame. Is that correct, Bill? Am I stating that?
Increase from 1 year to 2 years.
Correct. Okay. So that would be the adjustment, which if I look at the numbers, it's an increase in contribution from what was expected of about $1.1 million for fiscal 2022. It does increase the expected contribution in 2023 because we are flopping these numbers, but we can look at it next year. We can revisit it based upon how the plan performs. That may not end up being an accurate contribution for 2023, but this would be a good solution for this year, and it allows us to modestly lower our discount rate. So that's my motion.
So we got a motion by Vince. Do I have a second?
Yeah, Lanza will second.
Okay, Lonzo will second that. Is there any discussion that we want to have? Any trustees want to have any further discussions on this?
Yeah, Mr. Chair.
I do. I'm not able to raise my hand. I'm sorry. Sunita.
Sunita, can I come to you right in 1 second? I want to go to Dick real quick. Dick?
Yeah, Mr. Chair, correct me if I'm wrong, but I thought the last time we had this type of discussion some years ago, the employees paid more because we changed the amortization process. I think the motion is okay, but part of it I don't agree with. Franco, maybe you could put in, as I recall, the employees paid more last time when we made that change. Is that correct?
Yeah, it's going to bring it up a little bit. Not so much for tier 1, but more so tier 2 because they're sharing the expense 50-50.
It would increase the member rates about 30 basis points for tier 1 and 50 basis points for tier 2.
Bill, can you bring do you have the slide that have that information or close to it?
Yeah, hold on.
Yeah, and Dick, as I was looking for that to respond, there is a modest increase for everybody in the situation, city and members. My sense was it wasn't a significant increase, and I'm not trying to minimize any increase at all for the members, but.
And Bill,
So
can you be kind?
the amortization change we're talking about is only on pieces the city pays, but the discount rate change would affect the member rates. And so they would have been about 11% on average and increasing to 11.3 and going from 14 to 14.5 on tier 2.
So that I'm clear, and so the trustees and the motion and the public in general, the motion is just, you're reflecting the numbers of the motion. In other words, the ultimate wage inflation will remain at 3%, will not go to 2.75. So is the, if you may, is the quadrant in the middle, in the top middle part. Is that correct?
That's correct, Roberto. That was the motion that I made. And that number that shows the city contribution, which if we didn't make a change, I think would be approximately 215 million. That will also go up modestly for the city as well, even though we're making this amortization change.
Because of the further change adjustment, sort of flopping the 2 years that you mentioned of the amortization, right? 2022 and 23.
Correct.
Okay, understood. And Mr. Chair, I don't know if there are any other comments from trustees or questions. If I may, I'd like to comment just a couple of things. First of all, as always, I just want to applaud the board for having a very robust discussion. I think at the end of the day, legal counsel will tell you that's really the key. So I'm not as bright as everyone that has spoken in terms of the discount rate for the liability on the investments, comments by Prabhu. What I can tell you is that it has been a very robust discussion, many questions and considerations from different comments from trustees. And, you know, one thing that I have learned from Bill and really the actuarial consultants over my experience at public plans is that the actuarial process, I think they will call it, is self-adjusting, which means, you know, what we're trying to do today is the best assumption or estimate of accounting for the cost, because at the end of the day, the cost is going to be what it's going to be, right? Now, from the investment standpoint, it's clear, and I think Prabhu mentioned this, that with the interest rate coming down considerably on the 10-year yield, is making it harder and harder for the plans to earn returns and meet some assumption rates. But I just wanted to remind everyone that, you know, this whole exercise is really supposed to be long-term. Even though we do take a look at the economic assumptions on the annual basis, the intention is not to try to get it as right as possible on the annual basis, but on the long haul, which of course the challenge is we will know how we did now in about 20 years, which none of us are going to be here with these plans, right? That's the challenge. But again, I applaud you for having the right discussion. I think at the end of the day, council and Kyron will tell you the goal here is to be reasonable, which I think that without a doubt, we can say that your board is being reasonable on the assumptions. And second, of course, I think the right questions were asked about the implications to the membership and the plan sponsor. So those questions were also raised. As the city council mentioned, I did reach out to the city budget director, but I haven't heard back from him. But I'm aware that every year when they do work on the estimates, they always assume some dollars increase for the contribution. So I also want to mention, and I think, you know, again, the motion is 6 5/8. Your sibling plan, Federated, had this discussion at the meeting in November, and they did also agree to a discount rate of 6 5/8 for the plan as well. So that's always helpful. It's not really set in stone. The two plans do not have to move together, but and even though the allocations are somewhat similar, although they're not exactly the same, it sort of also makes sense that they are both in about the same area. But again, long haul, these are just reasonable estimates. And so again, I'm thankful for the discussion, and I think you're doing the right thing. So those are my comments.
Mr. Chair, Dick Santos.
Yes, go ahead. I was going to ask you.
I was just asking for clarification from my memory about what we did last time. I think Vince and Drew was on the right thing. I think the key to it, as Vince said, we revisit it a year and see how things are moving. We all want the economy to be better. We're changing people at the White House. There's all kinds of things and challenges going to be for 2021. I understand it. I'm just trying to get clarification, so I appreciate it. I think everybody is trying to make sure that the city's deficit doesn't get any longer. We're all blessed with retirement. We want to make sure everybody has the funding for the future. So those are just concerns, but thank you.
Thank you, Santos. And just and Santos, just to make one comment about your question in regards to the members' percentage going up. We've been at 6.75, I think, for 2-3 years now. And that has the biggest impact on members' rate that they're going to be paying. And so it's been fairly steady, but it has drifted up just very slightly. So this time, yeah, it will go up a little more than past years. But I do agree with the motion. Want to go, Sunita? I thank you for your.
Mr. Chair, can I correct something?
Oh, yes, go, Bill.
So in this chart, this 11% for the member rate and 14% for the member rate, that reflects the change in the wage inflation. And so if we actually looked at what the current member rates are, Tier 1 averages 11.2 and Tier 2 averages 14.5. So the wage inflation change is bringing those average member rates down. The discount rate is pushing them up.
Thank you for thanks for the clarification. And then also these are blended rates, correct? So, police is going to look different than fire when we see that in January, the numbers.
Exactly.
So, okay. Sunita, thank you for the patience.
No worries. I just want to put myself in queue. So thank you for doing that. Yeah. I guess the part that directionally, I'm completely on board with the proposal that we should lower the discount rate, whether it's the current proposal or something even lower, and also the wage inflation. But the part that I feel like I don't fully understand is, and also to address Councilwoman Foley's question, is the amortization piece. You've moved that down exactly the same as the inflation by 25 basis points. What is the sensitivity of that? I mean, it seems very logical that you would extend out an amortization during periods that we're going through right now. So what happens if you move that further down from 2.25%?
So if we move it further down, it increases the payments now and decreases them later. So it levels off the dollar pattern of the payments. So let me switch here again.
So it's exactly the opposite intuition I had. So thank you for clarifying.
Yeah, so if you see how these payments are increasing, and maybe if I put it over here, if we change this back to 2.5, you'll see it gets very slightly steeper. Let me drop it to 0. So 0 is just level dollar payments like your typical mortgage would be. That really flattens out these contributions, but it does so by increasing the early ones and decreasing the later ones.
Is there any harm in keeping it 2.5%? Why would you want to look? What is the relationship between that and inflation?
So the real thing that like the bond rating agencies look at is how fast that is expected to grow compared to how fast they expect city revenues to grow. And so traditionally, we've tied that to payroll growth. But I know S&P, for example, looks at inflation as their guideline. And so it's really just to be slightly more conservative, because we don't want those payments, as we've scheduled them, to become a larger and larger burden on the city budget. We want to keep them about the same. And so, you know, we had just tied it to inflation, and so looking to reduce it when we're reducing the inflation assumption. You could still keep it at 2.5, and that would still be a reasonable assumption. And that gets you a little bit in the first year.
Yes, that's the only thing I might consider if you're trying to optimize, not burdening the city too much in the short term, but being, you know, conscious of the fact that the discount rate direction, you know, the market environment or the interest rate environment is pulling us down. And wage inflation, you know, seems logical. So I don't know, that's the only consideration I might have for Vincent's proposal.
So just to carry on, would you be in support of Vince's proposal, or are you asking for an amendment?
If we're trying to keep the budget flat, because we don't want to burden the city at a time when things are really going bad, then it seems like the lever of the keeping the amortization payment at 2.5 doesn't cost as much.
Yeah.
That's the only amendment, and it's not a material amendment. If the other trustees feel like we should just keep consistent with past policy, that's fine as well. So I'm okay either ways.
Yeah, I mean, since it's for me, since it's a minimal change, and I don't think it'll have too much of a material impact on the city, you know, I'm okay with keeping it as, you know, current practice. But, you know, I would definitely want to revisit it next year if we find out that, you know, the city revenue has not recovered. If the city revenue doesn't recover, that probably means that there was issues with the vaccines and COVID is still rampant and the economy is shutting down. Hopefully we're not in that boat a year from now. But it's just, you know, as other trustees say, it's just another tool in the toolbox that we can use to, you know, change the numbers. So since it doesn't have a minimal impact, I wouldn't, I'd prefer to keep it, you know, as the motion carries. But if you're strongly in favor of changing it, then let's have more further discussion on it.
I'm okay. I'm okay with it.
Thanks, Anita. So I don't believe there was any other trustees that had any comments. So if that's not the case, is there any public comments? All right, if there's no public comment, we'll go ahead and do a roll call vote on Vince's proposal, which was second by Drew. Drew Lanza.
Yes.
Sunita.
Yes.
Howard Lee.
Yes.
Ezra Menon.
Aye.
Nick Muyo.
Aye.
Dick Santos.
Yes.
Vince Zeri.
Aye.
Franco Votto.
Aye.
And myself, Gardenier. Aye. All right, motion passes. Bill, you got, and Ann, you guys have everything that you need?
We do. We'll be back in January with the final valuation results.
All right, well, I appreciate all the hard work, Bill, and thank you for putting up with Drew for a second meeting in a row, and have a happy holiday.
Thank you, you as well.
Mr. Chair, before we go, I always try to keep the city apprised, and I want to make sure I provide the right information. So I want to ask a quick question to Bill, if I'm allowed, just 30 seconds.
Yep. Go ahead.
Bill, is the motion is such that the expected, you know how you provide the city the 5-year contribution, and we provided the letter last year, and that letter had a number for 2022, and that's the number that I saw in the screen, 215, and now it's going to be about 216, so the difference is just 1 million. Is that the right question?
It was 216 and now it's 217.
So, but the difference is,
we can follow up with the numbers that you can forward to the city.
I appreciate it. Great. Thank you. Thank you much.
All right.
All right. Thank you. So let's go ahead and move on to new business. Roberto, oral update from CEO, Roberto Pena.
Thank you, Mr. Chair. If you bear with me for a second first, I want to congratulate and welcome back Vince Sunseri for another 4 years. You can take that any way you want to, but he was interviewed by the City Council on Tuesday and he was reappointed. You can see his smile. He's just ecstatic and excited to be back. And kidding aside, Vince, it's been a pleasure working with you, and on behalf of the rest of your colleagues and really the stakeholders and the members of the plan, we thank you for your commitment, your efforts, and your willingness to spend hopefully another 4 years working with the board. So thank you very much, and welcome back.
Yeah, hey Vince, I'll pack a big oxygen bottle for you. It's a top tact.
I also wanted to kind of give you an update on the other seat that was supposed to be addressed was the police retired seat. And the process was initiated a few months back, but there were no applicants because everyone was so happy with Nick's work, no one wanted to apply. Unfortunately, Nick is looking to end his term at the board, but he graciously agreed to remain a trustee with Police and Fire until a new police retired member is appointed. And so we have been working with the city clerk. I believe it most likely will be early in the 2021 year. They will kick off the process for a new election for the retiree police seat. So I will keep you posted, but that means Nick will be with us for a few more months in 2021. I also wanted to let you know, you received an email a couple of weeks ago, and I believe we actually sent new iPads to all of you. I have also heard that some of you have had some issues with the iPads. We apologize. We know that happens from time to time, but hopefully you have received your iPads. If you have any problems, please reach out to us so we can work it through. And if you did receive the iPads and they're working perfectly, I'm assuming we also send you information how to return the old iPad back to the office. So again, hope everything is working well, and kudos to staff for getting the new iPads and shipping them to all trustees. So thank you very much. I also wanted to let you know that I sent you an email just recently, but I wanted to remind you our benefits manager will be out on leave until May 2021. And so that meant that we needed to make some adjustments. We're still working on a complete plan going forward, but it meant that we have to request freeze the senior benefit position in the pension side. And our contact person at the city mayor's office was gracious enough to approve the request. And so we are now searching for a new senior benefit analyst for the benefit function. We also just hired a senior benefit analyst for the healthcare function, which was a hire from the pension side. So then we also have to unfreeze that benefits position. And I also wanted to let you know the new senior benefit analyst now for the healthcare portion of the office is David Lisenby. David was a benefit analyst with the pension side. So we're going to be doing 2 searches going forward. One with the, for the benefits analyst and one for the senior benefit analyst of the pension side of the equation. And lastly, I wanted to let you know that we welcome our new senior auditor. He came in, started working this Monday, the 30th. We have an onboarding meeting with him early in the week. And so I will be introducing him shortly, early in 2021 at your audit committee meeting. Of course, the health open enrollment just ended last Monday, the 30th. And RRS received about 400 open enrollment forms. That's a combination of police and fire federated. Most of them are really re-enrollment for the health in lieu. I won't spend time explaining that detail, but that's for members that are not really using the health provided, medical health provided by the city. This is just something to keep track in case they ever sign up for it, they have some credits. Lastly, I wanted to close it by letting you know that as always, staff continue to work remotely, completing all the core duties. They're very much engaged and committed. Payroll for the retirees and disabilities are continuing to be processed. And a big shout out to our accounting staff for putting out, and it is in your agenda this morning, the popular the popular financial report, which is the PAFR, is a condensed version of the comprehensive annual financial report. It's on item 1.5. So if you got a chance and you can read it, let us know what you think about it. And that's it, Mr. Chair. I'm happy to answer any specific questions that we may have from the board.
Thank you, Roberto. Is there any questions by any trustees for Roberto? All right, if not, we'll go ahead and move to 4B, oral date from City Council Liaison Pam Foley, which I believe she had to leave the meeting. I'm looking for her name right now, and I believe she's left the meeting. She had another meeting to attend to, but she did give an update about the pension obligation bonds that the City Council is going to start looking into and get a study session going on. So we'll look forward to her update next month. So 4C, election of the board chair for calendar year 2021. So what was it, October, we had nominations for board chair, in which Drew Lanza was nominated. And so today we need to officially confirm that nomination with the vote. And then we will also need to do the same thing for vice chair. Drew, you want to back out?
No, I'm getting psyched. We're going to go to the top of Everest, baby.
All right. So if there's any discussion by trustees before we take a roll call vote, please speak up. If not, we'll jump to a roll call vote for Drew Lanza. All right. You know what? Let's try and take it at the exact same time, so we just do one roll call vote. We'll do the vice chair at the same time. Last month, I was nominated for vice chair, so I'll be happy to fulfill that obligation and work with Drew. If there is no discussion, we will go at the same time vote for board chair, Drew Lanza, vice chair, myself, Andrew Gardenier. Drew, how do you vote?
Yes, looking forward to it.
Sunita.
Big yes.
Howard.
Yes.
Eswar.
Yes.
Nick.
Yes.
Santos.
Yes.
Vince.
Aye.
Franco.
Aye.
And myself, aye. Well, congratulations, Drew. It's yours next month.
Yay.
Mr. Chair?
Yes, Franco. No, sorry, Dick.
Yeah, Dick Santos. Yeah, Going back to Council Member Foley, when she said she wanted some best advice for the potential bond investments, I do want to refresh back when Mr. Newfarmer was the city manager years ago, there was a $66 million bond loss, the city of San Jose, that made historic newspaper headlines and put us in a bad situation. So I would look to you and all of us to really get all our actuarial people and all our investors to really take and help out the council on that, because that was a major mistake way back, and find out how that all came about. So not to, so we can make sure we make the right, best decisions that can be made.
Thanks, Dick. And I think, yeah, we definitely have to take in that consideration, and city council needs to be aware of that stuff. From my understanding, this whole process, takes 9 to 12 months to go through, through the study session and all the underlying work that they have to do. So this is just starting the process. And they might decide, after they do their due diligence that, it's not right for San Jose. So
Yeah, we have to learn from from mistakes back then.
Yeah.
All right.
Thank you for the comment. All right, it brings us to 5-1, retirements. So we do have one early, Roberto, I got a quick question for you.
Yes, sir.
So when we, just for educational for myself and the other trustees, the reason we had to approve of these because they can't officially get paid if we don't approve. Isn't there something like that?
That's my understanding.
Okay. So if we, because I heard that on
Frank Covado.
5-2I.
Yes.
Yeah. So if we don't vote on it, he can't retire.
Yeah, that's what I heard. And, the board has a history of doing that from time to time when they think it's not appropriate. So you definitely have the right to do so if that's how you feel about it.
Okay. So
I don't know if Franco has any comments on that.
We could defer it to next month maybe then.
Yeah, I would say a month or two. It wouldn't hurt anyone.
Okay. All right, let's go to early retirements. 5-1A, got Mark E. Stevens, police officer, police department, effective December 26, 2020, with 21.64 years of service. Service retirements, 5-2A, Reed J. Beersdorf, police officer, police department, effective January 9th, 2021, with 25.23 years of service. Damian Bortolotti, police sergeant, police department, effective January 9th, 2021, with 27.82 years. Lisa D. Gannon, police lieutenant, police department, effective December 12th, 2020, with 27.78 years of service. Donald Guest, police officer, police department, effective January 9th, 2021, with 24.8 years of service. Robert E. Amos Burstag, police lieutenant, police department, effective January 9th, 2021, 27.42 years of service. Michael H. Kim, police captain, police department, effective November 29th, 2020, with 26.19 years of service. Kevin Laundrie, police officer, police department, effective January 9th, 2021, 28.17 years of service with reciprocity. Leonard J. Lim, police officer, police department, effective December 26, 2020, with 26.97 years of service. Paul R. Messier, police lieutenant, police department, effective January 9th, 2021, with 27.3 years of service. Eric J. Kwan, police sergeant, police department, effective December 12th, 2020, with 26.34 years of service. Joseph P. Snyder, police sergeant, police department, effective January 8th, 2021, 25.49 years of service. Franco Vado, police officer, police department, effective January 9th, 2021, with 25.26 years of service.
Oh, sorry.
We got one more meeting with him. Jose L. Vargas, police officer, police department, effective January 23, with 2021, 26.18 years of service with reciprocity. Douglas S. Wedge, Police Lieutenant, Police Department, effective January 9th, 2021, of 27.42 years of service. And we'll capture the vested ones real quick. Sean M. Eastman, Police Officer, Police Department, effective December 30th, 2020, with 30.45 years of service with reciprocity. Gina Teeperton, Police Officer, Police Department, effective December 16th, 2020, 25.66 years of service. And Richard J. Westfall, Police Officer, Police Department, effective December 29th, 2020, with 38.45 years of service with reciprocity. So can I get a motion for approval?
So move, Santos.
Motion by Santos. I will second it. Gardner will second it. And roll call vote. Drew Lanza.
Oh, sorry. Aye.
Sunita.
Aye.
Howard.
Yes.
Eswar.
Aye.
Nick.
Aye.
Santos.
Yes.
Vince.
Aye.
Franco.
Aye.
And myself, Gardner, aye. This is this month and next month is usually our time for, we got a lot of retirements coming up. These are all police officers, and I can't appreciate enough the time that they service that they put in for this department and city. I hope they're all retiring healthy and they can enjoy their retirement. Thank you very much.
Andrew, it's Vince. If I just wanted to comment to thank Franco for his service. It's really been nice to get to know him and to work with him on this board, and the city's losing a great officer.
Here, here. Mr. Chair, I just realized, and I wonder, you're from the fire side. I don't know that I ever seen a situation where all the retirees, even the first vest, and they're all police. There's no fire. Is that?
Yeah, I haven't seen that either. I would anticipate some more next month, but then also a lot of it is timing in regards to when the academies, got out. And we have an academy that graduated 25 years ago, but they don't hit 30 years or their 25-year mark until January 28th, 29th.
Got it. Okay,
and
that's
so
what it is. Okay.
Some people might not hit the COLA in time. So we'll see what next month looks like.
Well, Roberto, remember I said this a few months ago, with everything going on nationally, that this was going to happen.
Yes, that
We're coming
you did mention
available, and there you are. I don't want to have any part of this. So I think this is something you're going to see going on for a little while, unfortunately, because we're not going to be able to hire at the rate that they're going to leave.
Understood.
Yeah.
Mr. Chair?
Yes.
Yeah, Muyo here. We just want to wish all of these folks happy and healthy retirement moving forward. There's a lot of years there walking. 27s. Can you hear me?
Yeah, you're in and out, but we can hear you at the moment.
Those 26 and 27s, I'm guessing, are people that just turned 50. But a personal note of thanks to Franco, and then also the Press Information Office. So good luck to all.
Thank you. Now, then I want to say, personal thank you to Franco for, his service and commitment, to the city and also to this board. You've been phenomenal to work with and get to know, and, best of luck, in your retirement. So let's go ahead and move on to 6, death and survivorship notifications. A notification of the death of George A. Graham, police lieutenant, retired September 4th, 2010, died September 13th, 2020. No survivorship benefits. Notification of the death of Jess M. Sanchez, police officer, retired January 26, 2008, died October 7th, 2020. Survivorship benefits to Mary Ann Sanchez, spouse. At this moment, let's take a moment of silence. Thank you. Condolences out to the families of George Graham and Jess Sanchez for their losses. Nick, did you know any of these people, officers?
Yeah, I actually had the honor of working with both with George and Jess. When I was a young officer, a couple of experienced guys that I had the opportunity to work with, learned a lot from them. And so sad day for us today, losing both of them. And if I'm not mistaken, Franco, you can verify, but I believe Jess's son came to work for the PD. I don't know if he's still there or not, but multi-generational family there.
Yeah, I believe he did. And I just wanted to point out that is way too short into retirement to pass away.
Yeah, absolutely.
All right. Well, thank you for those comments, Nick. Let's move on to committee minutes, reports, and recommendations. 7.1 Investment Committee. Eswar, I don't believe we met, but do you have any updates, comments you want to make?
No updates.
All right. Risk audit. Looks like last meeting was October 15th. Vado, any updates?
Nothing new.
All right. Governance. Muyo, is there any updates from you?
No, sir. Nothing new. Scheduled meeting in a couple of weeks.
Okay. Perfect. Disability Committee. Santos.
No, Mr. Chair, we'll have our next meeting on December 7th. I'll yield to Drew. Drew, any comments?
No, Dick, I think we're doing great.
Thank you, Mr. Chair. Again, just keeping the paperwork going. Thank you.
All right, thank you. And we'll go ahead and receive and file the minutes at 7.4B for the October 5th, 2020 Police and Fire Disability Committee meeting minutes. Brings us to 7.5, the Joint Personnel Committee. We had a meeting on November 10th. Vince, you want to provide any updates?
Thanks. Yeah, Andrew, we do need to review with the board item C. If we can open up that document, that's the review of the procedures for the CEO evaluation. So this has been a lot of work. This is a joint committee of both police and fire and the federated board. Pretty intricate documents. We will have the consultant there to help us through this process when we go through it. But on page 2 of that document, this is item 7.5C. What you will notice is that we have 2 tables of the metrics we're going to be utilizing as we evaluate the CEO. 70% of the weight is for what are called organizational outcomes. These are things along the lines of investment performance, benefit administration, cost effectiveness, and member service. And then 30% of the weight when we evaluate and do compensation considerations will be related to management methods. And those are things like enterprise risk management, human resource management, stakeholder relations, operations management, and leadership. The next page, page 3, thank you for putting that up here. Go to page 3. What you will see here is as we do the scoring, what the awards can be for the individuals. If they score below 70, they would not receive a compensation increase above what is the standard increase the city would grant. If they have a satisfactory recommendation, they could be eligible for a 1% increase plus 2 days of executive leave. And what we did in the commendable and outstanding was listed ranges. These ranges are a little bit different than what the city has. The city commendable essentially is 2 to 2.5%. And we had given a range of 2 to 3% for commendable. And outstanding, the city is 2.5. And we listed a range of 3 to 5%. This is again the increase above and beyond what would be the normal increase provided by the city. Plus, you'll notice the executive leave days that are provided there. And then finally, the last page is kind of trying to pull it all together. It's again a little overwhelming. It's actually probably easier spending time looking at the quarterly financial reports of the plan than trying to figure this out. But it's a combination of looking at the scoring on both the organizational outcome and management methods to really precisely determine what type of compensation increase they should be given. And the goal of creating this was to develop a system that can be carried forward from board to board and take away a little bit of some of the pure discretionary and have it a bit more automated and driven by various outcomes. So this is approved by the Joint Personnel Committee. It's simply a report to the board for you to review. It does not need to be approved by the board as long as the Joint Personnel Committee approves it. We're still working on the document for the CIO, given the fact that there are metrics on the investment side that we need to dig in further on and evaluate before we complete that. So that will come to you at a future date. That's my update on the CEO evaluation.
Thank you, Vince. Is there any questions from the trustees regarding this? All right, if not, thank you. We'll go ahead and receive and file the minutes from October 20th, 2020 joint JPC meeting. Proposed agendas are at the very end. Any agenda items for next month? All right, any public comments?
Yes, Mr. Chair, Dick Santos, just from all our trustees and yourself to all our staff and CEO and everybody, thank you for a wonderful job all year. It was very difficult during the C-19, but everybody be safe and have great holidays. Thank you.
Thanks, Dick.
Thank you. Mr. Chair, if I may, again, I want to echo the words by Trustee Santos from staff. We want to thank all of the board members for your dedication and your work during this past calendar year. 2020 has been a challenging one with the pandemic. We want to wish everyone and all stakeholders and members of the plan very happy holidays. And I wanted to close it by making sure that we thank you, Andrew, for your efforts and steady leadership as the chair during a very challenging 2020 COVID-19 pandemic. So again, thank you much, all the board for your work, but specifically this year, I want to single out Andrew because of your leadership as the chair. So thank you very much and happy holidays to all.
Thanks, thanks, Roberto, and I look forward to continue working with Drew on the next year. I also want to thank staff. Without these meetings can't happen without them. So thank you for all the prep work going into this meeting, agenda preparation, the new iPads, coordinating all that stuff. You guys, I know this is a busy season with all the healthcare registration going on for retirees. So thank you very much. We definitely appreciate all the effort and time and commitment that you have put forth to this department and to this plan. Just a reminder, next meeting is January 7th. So it'll be the first full week of January when we'll next be meeting. If there's no other comments, then let's adjourn this meeting. Thank you. Happy holidays, everybody.